In this presentation, we will take a look at cost volume profit analysis, CVP analysis. This will be a long presentation. If you would like to jump to points within the presentation, take a look at the description below, which will have links to those points, as well as a description of what will be included at those points. In this presentation, we will discuss cost volume profit analysis, or CVP analysis. First question we're going to have is, why use cost volume profit analysis? What is cost volume profit analysis, CVP analysis? First, we want to remember that this is a managerial accounting topic. So when thinking about financial accounting, we typically will not hear the term CVP, cost volume profit analysis. We're not applying rules such as generally accepted accounting principles here, and therefore we're not required in any way to have a cost volume profit analysis, a CVP analysis. Why then would we do it? It's for decision-making processes, it's for internal processes, it's for managerial accounting. One of the major benefits that a cost volume profit analysis will provide are planning tools. When we break things up into a cost volume profit, a CVP analysis type of setup, we have a much easier setup to run scenarios, to run plans, to run projections, to look out into the future and think about what could happen. Now you might think, isn't that just what the financial statements are for? What about the normal income statement? Isn't that supposed to measure performance, show performance, and help us to make decisions in the future? And the answer is yes, the financial statements do that, but there are some limitations in terms of forecasting. So remember, when we think of a normal type of financial statement, the income statement is usually what we're going to consider when we're considering performance. Those are the timing accounts. Those are the accounts that are determining how we did over time. In essence, revenue minus expenses. How much revenue did we have, and how many expenses do we have to incur in order to help us to generate that revenue, giving us that bottom line number, that net income. The difference usually is where we categorize the costs. When we think about a normal type of income statement, we want to think about that income statement from the perspective usually of an outside user. Now again, that doesn't mean that an inside user, a managerial accountant, doesn't take this same information, but note that when we think about generally accepted accounting principles, remember, we're thinking mainly about the outside user. The outside user wants to see what really happened over the last year, and they want to see the big picture view of that so that they can make investment decisions. And therefore, the grouping of the expenses are going to be in alignment with that objective. So we have the revenue, and then the expenses is what we're considering. We're considering here a manufacturing type of company, usually broken out into cost of goods sold, those things related to what we are selling. That's a category type of grouping. We're grouping anything that is related to the selling. Remember that if we make things, we're talking about direct materials, direct wages, overhead. A lot of things are going to go into that cost of goods sold number. As we consider it, the behavior of those costs will be much different, but we want to group them in this category by what they do. What do they do? They're there as part of the inventory that we used in order to sell to help generate the revenue. That's how we're grouping the expense. That gives us the gross profit. And then we have the other types of expenses, including the operating expenses of selling expenses and administrative expenses. Now again, these administrative and selling expenses are in terms of what types of things they are for. They're clearly for selling and administrative, and that's going to be, they're grouped by their function. They're not grouped by the behavior or how the costs act. And therefore, when we get to the net income, then of course the net income is the gross profit minus the operating expenses. That gives us our net income in a normal type of income statement for a manufacturing type of company. This gives a great summary of what has happened. It does so based on the groupings of why we made these expenses in terms of what it's doing for us to help us to achieve the goal of revenue generation. The problem is if we look out into the future and we start to run scenarios and say, well, what if we sell more stuff? What if we sell less stuff? It's more difficult for us to run through this entire type of income statement in a budgeted type of income statement in different scenario settings, because the things that are involved in these different categories act differently as production level, as the volume of production increases and decreases. So for example, in cost of goods sold, we might have the wages could increase to some degree by the people that are working hourly. It might go up with each level of production. But we might have some people that are salary too, and their wages aren't going to do anything if we go up in terms of the amount that we produce. And therefore, if we were to increase production and think about, well, what would happen if we sold this many units next year or this many units, and we had a set of increasing number of units that we could possibly sell, and we want to just run a bunch of projections on that, it would be difficult for us to do that if we group costs this way by what they're for rather than the behavior of how they act, because then we're going to have to go into these and say, okay, well, how is that going to increase or decrease wages? And it's difficult to know that because of the structure. So that's going to be leading us to the idea of grouping costs by behavior. What we want to know is that if we sell, for example, coffee cups, if there's an increase in the number of coffee cups, what's going to be the increase in net income? To do that, we need to structure our income statement differently, or at least to do that a lot more easily. We can structure our income statement differently. Another common question for managerial accounting is, if we're thinking about the rent or the fixed cost, let's say the rent, if we want to know how many units we have to sell in order to pay the rent, where it's how many number of units must we sell in order to cover the fixed cost of the rent. These are types of questions we consider in a CVP type of analysis. How does it work? What's the major process that we're going to use in a CVP type of analysis? We're going to take the expenses and we're going to break them up not by what they do. We're not going to group them by selling and admin or cost of goods sold, but by how they act. So we're going to break up the expenses by how they act. We want to break up all the expenses into two categories: fixed costs and variable costs. So we want to see all the expenses and break them up into fixed type costs and variable type costs. Now, a lot of costs, this will be easy for us to do. If we think about a salaried employee, they typically are going to have a fixed type of cost. If we're thinking about the rent is what it is. It's going to be fixed no matter how many units that we sell. And there's going to be some things that are variable. If we're talking about direct materials into our inventory, typically as we produce more, then it will go up at or standard rate as we increase the level of production. Note, however, that the CVP analysis does make us or force us to take those types of costs that don't line up specifically into fixed or variable and break them up in some way. So that's going to be one of the problems that we have with a CVP type of analysis. We want to break everything up as if they, by their nature, behave as fixed or variable type costs. Not all costs do. Many do not, which means that we're going to have to make some type of estimates in order to do so. And what's going to be the payoff of doing that? Once we do that, then we can make these projections much easier. In essence, then, we want to break our normal type of income statement into a contribution margin type of income statement. So we're going to have the same bottom line, the same net income, but we're going to get there a little bit differently. We're going to group things a little bit differently, or a lot differently. We're not grouping by what these expenses do for us. We're grouping by how they behave. So in the variable costs, for example, we have the direct materials, we've got the direct wages, and the sales commission. Notice that sales commission is totally different than, say, cost of goods sold, which is what the other two items are in. In a normal income statement, we wouldn't group this way because they are serving different purposes. Although it's for revenue generation, they serve different purposes, different categories within that goal. But in a contribution margin, we group them in this format because they behave similar, and that will help us with projections, as we'll see. That'll give us the total variable costs. Then we'll take the revenue minus the total variable costs. We call that the contribution margin. Again, you'll never see a contribution margin in generally accepted accounting principles. It's not in a normal income statement. You're probably considering about this stage in the income statement is something called gross profit on a normal income statement, revenue minus cost of goods sold, sales minus cost of goods sold. That is not this number. They're not the same at all here because remember, variable costs, they're not by what the costs is for, they are by the behavior. And then we have the fixed costs. These are the costs that don't change with the level of production. In our case, we got the taxes, we got the maintenance on the factory, depreciation, lease, administrative salaries, rent, and then the rent on the office as well as the rent on the administrative office. Those giving us the fixed costs. If we subtract out then the contribution margin minus the fixed cost, we get the income before taxes, then the tax calculation, than the net income. So again, bottom line, the same as a standard income statement. The approach different. As you can see here, it doesn't really show you exactly why we would do this yet, but when we consider how to think about projections in the future, we'll see that this format will be much more useful and easy for us to work with. In this presentation, we will take a look at an overview of the process, an overview of an example problem for the cost volume profit analysis, the CVP analysis. Our goal here is to show both the power and the purpose of the CVP process, the cost volume process analysis. Remember, as we go through everything in the future, this is a managerial accounting concept, not required, a tool for management. Management can decide to apply it or not. What are going to be the benefits of applying such a cost volume profit analysis? Best way to look at that, go through an example problem, see how it's formatted, see the big picture, how it's laid out. In future presentations, we'll drill down into the components in more detail, talking in more depth about those components. In overview, we can compare and contrast a cost volume profit analysis to an income statement. Oftentimes, we're looking for projections into the future. Cost volume profit analysis helps us to do that. First, let's start off with the standard point, that being the creation of the income statement from, say, a trial balance. We have the normal income statement, which is usually based on prior data, usually for external users, and is usually grouped by the function or what the use of the cost is. For example, if we take a look at our trial balance here, and we're just to create an income statement from it, we'll do this more in depth in future presentations. But I just want to point out that this trial balance is in balance. It's everything. It's the balance sheet and the income statement. It's obvious it doesn't have a lot of detail, but just note that we here, of course, are concentrating on the income statement. We're concentrating on performance. This income statement will be more of the standard type of format, and then we will adjust it. It's coming from the same data to the CVP, cost volume profit type of format. So here we have a normal type of income statement, which would usually start off with revenue. Notice we're starting down here on the trial balance. We're not dealing with the balance sheet items in our example because we're focusing in on the income statement. Then we break it out by cost items or by function. What are the expenses? And we're grouping them by what they do. What's the purpose of expenses for a business? To help us generate revenue. But also we want to put it in there by function. That's what we do in a normal type of income statement. In other words, cost of goods sold is the cost of the inventory. These are costs related to the cost of the inventory. We then have gross profit, revenue minus cost of goods sold, subcategory for a manufacturing type of company typically. Then we have an operating expenses, starting with the selling expenses of operating expenses. Again, breaking out the expenses by what they do. What are they for? What's the purpose of these expenses? These are the selling expenses. Then we have the administrative expenses, again, broken out by what they do, part of the administration process. That's what they're for within the company for the ultimate goal of revenue generation. And then we're going to have the total operating expenses. We'll calculate the net income and income tax, and finally, the net income. This is the standard format. Now, we have to do this for generally accepted accounting principles typically. This is the format that most people will want to see that are external users, therefore we must do it. We may want to change this, however, for internal use, especially when we're projecting out into the future, because these costs that are grouped by behavior will not change relative to the change in level of production as easily as we would like, and therefore forecasting with this format is more difficult. If we change the level of production, change things like the sales number that we're going to have, then this income statement is more difficult to calculate because of the grouping. Therefore, we're going to format this into an income statement, which we will typically call a contribution margin type of income statement. Same bottom line number, the 72,270, however, now breaking this out by what the behavior of the cost is. So we'll start off with the revenue again, or sales, and then we'll break out variable costs as opposed to cost of goods sold, and that'll give us the total variable cost. We'll discuss more what variable costs are later, but just note that it's being a grouping by behavior. as opposed to being grouped by what they are for. In other words, this isn't cost of goods sold. These aren't items that are related to the selling of the inventory. These are items that behave in a similar fashion. In other words, they go up or down in a similar fashion with relation to increases and decreases in production. Again, we'll talk more about that later, but just note that difference between our analysis here, the different format of our contribution margin income statement. And then we're going to have the contribution margin, and this is in a similar place as the gross profit, but it's different because we're talking about sales minus the total variable costs, giving us the contribution margin. So the revenue line is the same. These are variable costs, however, not cost of goods sold. And then we're going to have the fixed costs. These items then are the fixed cost type items. We'll go into them in more depth in a future presentation, but just note that, again, we're grouping these by behavior, by how the costs behave as opposed to what the costs are for. Next, we can calculate the income before taxes and the income taxes, and finally net income. Finally getting to that net income, $72,270. If we compare these two types of income statements then, this being the one that we have to basically use, usually for external users, the normal income statement, this being our internal use income statement, a contribution margin income statement, a CVP income statement, a cost volume profit analysis income statement, we get to the bottom line in a similar fashion here, or same bottom line, but we go about it in different ways. This one being grouped, once again, categorizing those expenses by what they do, what's the purpose of the expense, as opposed to over here categorizing expenses by how they behave. Both have their pros and cons. There's a reason why we have the information grouped in this standard format, that we want to see it in that format many times because we want to see what the grouping is and how much we're spending in a particular group. However, there are benefits as well to a contribution margin type of income statement, as we'll see. So what can we do with this contribution margin income statement? We know what we have to do. First, we got to make this type of income statement, which means we're going to have to break our costs out into variable costs and fixed costs, and then we're going to have to reformat this information into a contribution margin income statement, and that's going to take some work. What do we get from it? Because it's not a requirement. It's an internal managerial accounting tool. Well, one of the things we can do with this is we can take this income statement and break it down to a per unit type of income statement. In other words, we can get to the sales, the variable cost, and the contribution margin per unit. And once we're there, we can then use this information to make projections a lot more easily. For example, if this is broken out by behavior, we could say that the revenue then is going to be the total sales, we're going to say is 1239750 divided by the number of units, 4350, and we get the 285. So we're going to say the revenue per unit is 285. You can imagine if we sell things, of course, we're going to have a fixed sales price. That's one of the assumptions we have to make for this analysis, that we have a fixed sales price. But just note that if we make that assumption, we can say, okay, here's the revenue per unit. We can do the same thing with variable costs. And this is the key. This is what we can't typically do in a normal type of income statement. We could take the variable cost items and we could say, all right, this is the 247950 divided by the number of units, which is 4350. And that's going to give us the 57. So in this case, we have 57 for the direct materials. So that's what we're getting from this. We're going to break these costs out, and we're going to break them out by behavior, and we'll talk more in depth about this type of behavior, variable and fixed. But see, this is going to give us a benefit. Then we have the direct wages also behaving the same, sales behaving the same. Those items gives us our total variable costs per unit, and then the sales minus the total variable costs is what we're going to give our contribution margin per unit, which we could also calculate as the contribution margin total divided by the number of units, 4350. Now, that's going to be a useful number for the projection purposes. If we want to think about costs into the future, this is a useful number. Now, you might say, hey, you made some assumptions there when you did that. And we'll talk about some of the assumptions that are made for cost volume profit analysis and what we're going to do about that. But just note, this is a tool that's going to be a useful tool for us. So we're going to move forward here. We can also have the contribution margin percent calculated as this number, contribution margin per unit, divided by the revenue number, or this number divided by the revenue, representing the contribution margin as a percentage. Once we have that, we can use our calculation to get to a break-even point. This is going to be kind of the starting point, is the first kind of question, or one of the fundamental questions we would ask in business is like, well, how many units do we have to sell to basically break even, to cover our costs? Once we have our costs broken out between variable and fixed costs, we could start off with the fixed cost. We're going to say, all right, there's the fixed cost, 388,500. And if we divide that by the contribution margin, here's the contribution margin, the 117, we could say that the break-even point is 3,321. So let's think about that in a little bit more in depth. If we have the fixed costs, something like the rent, things that don't change with the level of production, they are what they are. This is what it is, doesn't change with the level of production. Contribution margin per unit, as we see, is revenue per unit, or sales per unit, minus the variable costs per unit. In other words, 117 in this example is how much we are earning, how much profit, how much we're going home with after variable costs, not including the fixed costs. So this is how much we're going home with until, of course, we have to save that up to pay the rent or the fixed cost. That's a simplified example. There's more than just the rent and fixed cost, but that's going to be the idea. So now we're generating this much revenue, or this is how much we're going home with, the net kind of profit, the contribution margin per unit, and we divide that into the fixed costs, things like the rent, and we say, well, this is how many units, 3,321, which we must sell in order to cover the fixed costs. In other words, that's our break-even point in units. That's what's going to give us a zero net profit. That's a good starting point, because then we can start from there and start to calculate our profit number. And we can also think of our break-even point in terms of revenue. There's a couple different methods, but one method, obviously, if this is how many units we have and the sales price is $285, we multiply those out. That means that our break-even point in terms of dollars, the revenue, the sales we need, $946,346. Now let's consider forecasting. Once we have this information broken out, we looked at it in terms of possibly prior information we had in the past. Then we would want to forecast into the future, which typically starts with the prior year information, making adjustments on what we think could happen in the future, projections, and then making forecasts from it. This is where cost volume profit analysis, CVP, is really beneficial, because we can easily run different scenarios with very few changes. So in other words, if we just adjust the number of units that we expect to produce and sell, we can set up a worksheet to help us with projections into the future that is far less complex than one we would have to create in a normal type of income statement, because we broke out the costs between fixed and variable, because we're looking at this information by cost behavior as opposed to the grouping of costs by what they're used for. So a forecast will look something like this, similar kind of contribution margin income statement. However, now we're forecasting into the future for it. So what we're going to say here is, if I predict then that the units that we're going to sell are 3,321, which was our break-even point last time, so in essence we're testing our break-even point, then we would have the total revenue per unit, 285 times 3,321, gives us total revenue 946,346. So these are the two numbers. We've just tested basically this number. So there's that number in our contribution margin income statement forecast. And then we've got the total variable costs per unit, which is the 680 or the 168 times the number of units, 3,321. That gives us our total variable costs. If we multiply those out, contribution margin, then we could do this two different ways. We could say it's the 117 times the 3,321 units gives us 388,500, or we could take total revenue minus the variable costs to give us that 388,500 as well. If we look at our fixed costs, then in this case, they're going to be the same as the contribution margin, because this is the break-even point, resulting in the forecast profit or net income forecasted before taxes of the zero. So this then is our break-even point. The beauty of this worksheet is that we can then calculate a profit much more easily. If I just change this one number, Because of the simplicity of this, because we broke it out by behavior of costs, we can then work this through the worksheet very easily and come up with projections very quickly. So if I change this number, for example, to 4,000, then we just change these items in an Excel worksheet, a very pretty simple Excel worksheet, which we'll take a look at. We'll then generate the new numbers, and here's the bottom line. Here's the 79,500. If I change this to 5,000, here's our bottom line number. If I change this to 6,000, here's our bottom line number. Everything will adjust for us. 7,000, here's our bottom line number, and so on and so forth. 8,000, and we can run the comparisons and do the side-by-side comparisons. You can think about scenarios saying things like, well, what if I increase the fixed cost for something like advertising, and then I figure that I'm going to sell more units from 4,000 to 5,000 because of the advertising? Well, there's a lot less factors we need to change in a CVP type of analysis when we start doing these projections than if we would have a normal type of income statement. When we start changing the units, when we start thinking about different scenarios and increasing capacity and adding things, then in a normal type of income statement, all of those kind of projections is a lot more complex to work through because the income statement is not broken out by behavior of costs. Here, because they are broke out by behavior of costs, it's a lot easier. Now, there's assumptions we have to make to do this. We'll talk a bit about those, and we'll go into some more depth about some of these components that we've been talking about in overview in future presentations. In this presentation, we will discuss methods to calculate ending work in process and units completed. In a prior presentation, we went through the flow of inventory from raw materials to the finished goods inventory, and then the sale of that inventory and the expense of it in the format of cost of goods sold. As we did that, you'll note that we had these items or these times when we had to transfer from Department A, for example, to Department B in our process cost system, and from Department B to the finished goods. The journal entry to transfer from Department A to Department B would be to credit Department A and debit Department B, in essence decreasing Department A and increasing Department B. In our example, we're discussing like making candy. In that case, we would take it out of Department A once the candy is done, put that into Department B where the Department B applies the wrappers or something like that. And then we're going to take it out of Department B once the wrapper has been given and put it into the finished goods. So then we'll have the completed product from Department B to the finished goods. We're going to need some method, however, to note how much is still in Department A and how much is still in Department B, how much is still in Department B, and how much is in the finished goods. There's two methods typically to get to that determination. Or in other words, each department, in our case Department A and Department B, have to do two numbers or have to calculate two numbers. One is going to be the cost of its ending work in process inventory, what is still in the ending work in process at the end of the time period. In the case of Department A, with us making the candy, what is still in the work in process not completed. And with regard to the packaging, what is still work in process and not completed, not moved out to ending inventory, and cost of its completed units that were transferred to the next stage of the production process. We're going to have to figure this out, and it's not the easiest thing to figure out. It's not as straightforward because the units are not totally complete. So we're going to have to determine how much is going to be still in process, how much has been transferred out in each department. In our case, we had an example of two departments, the production department and the packaging department. Note that when we think about the journal entry, we're thinking about a dollar amount, of course, because we're thinking about financial statement transactions. To get there, however, we're going to have to think about units of inventory. So we must calculate the units within each department, the units of inventory within each department. A couple methods we can use to do that. One's the weighted average method, and the other is going to be a first in, first out method. Now, you might recognize these methods as the flow of inventory or flow assumptions that we would make if we were a merchandising company purchasing and selling inventory and making some type of flow assumption. It's a similar type of assumption here, but the application of it will look a little bit different within the manufacturing process. Weighted average method. Calculated unit cost by combining costs and outputs from the current and prior periods. So in other words, we're looking at costs and outputs and in some format combining them with the current and prior periods. makes no distinction between work done in the prior and current periods. It blends together the units and costs from the prior and current periods. So in so doing, we're going to blend them together. We're going to basically, in essence, that's going to be the averaging process, and assume the averaging process will basically work itself out. The average will work and be okay to use. The weighted average method, because of this blending process, because of us not basically making a distinct cutoff between the work in the prior period and this period, in other words, because of the blending together of units and costs from prior and current periods, is often a little bit easier, if not quite as precise, and that would be one reason to use a weighted average method versus the first in, first out method. First in, first out method calculates unit cost based only on costs and output from the current period. So we're looking at the costs for the current period and applying out those current period costs with a first in, first out assumption. Our comprehensive problem will use the first in, first out method, and our example problems and our illustrations will be using the weighted average method. In this presentation, we will take a look at an income statement for a manufacturing company. We're going to first take a look at the standard structure for an income statement so that we can then compare and contrast it to a CVP or a contribution margin income statement. So this is going to be the standard type of income statement that we will compare and contrast to. We're going to generate this from a trial balance. The only reason we're going to have the trial balance here is just to see that we have something that is in balance that will then make into the income statement, just to give us some awareness or remember the fact that the income statement is going to be part of the financial statements, which of course will include the balance sheet and the income statement. When we consider the full double entry accounting system, we're thinking of these items being linked together. So a very simplified trial balance, all we have is cash on the balance sheet and accounts payable, assets, liabilities then, and then we got the retained earnings, and then we have where we are focusing in on here, this is all balance sheet stuff, the income statement, where we have the revenue, the direct materials, the direct wages, the sales commission, the taxes, the maintenance, the depreciation, and so on. Revenue then minus the expenses, giving us this net income, $72,270. Revenue in our case being a credit represented with brackets, the expenses being debits represented with non-bracketed numbers, and the credit here minus all the expenses gives us the income, not a loss, credit balance of $72,270. All of the debits and credits from the cash on down to the tax, to the income taxes would add up to zero. The debits minus the credits add up to zero. So we are concentrating here. We're just going to take these numbers and put them into the structure of a standard type of financial statement, income statement, something that would be closer to generally accepted accounting principles, then compare and contrast that to CVP or a contribution margin type of income statement in future presentations. So the income statement would typically start off with revenue. For a manufacturing company, it might be called sales, but it would be revenue, income, sales. That, of course, is just pulling over the revenue numbers. We're pulling over that number, removing the credit, putting it into a plus and minus format. Here, we're going to put it on the outside because we're going to have some subtotals that will be then generated. Then we have a subcategory, typically in a normal financial statement. We're not going to see this in a contribution margin type of income statement. We will see it in a generally accepted accounting principle type of income statement grouped by category, not by behavior of cost, as we will see in a contribution margin. That category being cost of goods sold, the category related to the inventory, the cost of the inventory of the things that we are selling. And that's going to include, notice the colon again means that we're going to indent it, have some type of subcategory. It includes the direct materials, that's part of the inventory. It's going to be pulled into the inside because it's going to be a subcategory, which we will then put to the outside with the cost of goods sold once we've completed it. And then we're going to have the wages. So we've got the wages. That's going to be part, this is direct wages, part of the wages that were on the materials that we are producing. Then we had the overhead. So the overhead is going to be part of the costs of the production. And remember, that's the bucket of everything else that we're going to put into the production that doesn't fit directly into the direct materials and direct wages. Or in other words, if it's a job cost system, it doesn't fit directly into the job process cost system. It doesn't fit directly into any particular process, but it should be applied out to them. And that's going to include most of the things that we see in a problem if it says something that it's a factory involved in it. So here we have the taxes on the factory. So we're going to add that in there. It's going to be 13,500. Then we've got maintenance on the factory. We'll say that's 27,000. And then we have depreciation, 87,000. And then lease, we're going to say is 27,000 on the factory. That's 154,500. So 154,500. And then if we add those up, then the 247,950, the 387,150, and 154,500 is going to be the total cost of goods sold. Remember, that's related to the grouping of the items for the inventory that we sold. That's going to give us the gross profit. Now we're in the outer column. Revenue minus the total cost of goods sold is what's going to give us that gross profit. It's going to be a very important number for manufacturing companies because we want to know the relationship of the costs related to the inventory and the revenue. Then we're going to take out from that the operating expenses, which includes selling expenses and administrative expenses. We typically group once again by the category, by what it's for, what's the purpose of the expense. So in this case, we've got the sales and commissions. So we're going to say that 95,700. We then have rent on the sales office. That's going to be the 77,000. So here's the 77,000. Then we're going to have the total selling expenses. The total selling expenses we'll put into the outer column, that being the 95,700 plus the 77,000 for the 172,700. We're going to break that out into the outer column. Next, we're going to have the type of category of the administrative type of expenses. Once again, grouping these items by what they do, what their function is. Administrative salaries of the 107. And it will include the rent on the administrative office of the 50,000, the 107, the 50,000, that adds up to the 157,000 for the administrative expenses we put into the inner column. Now, note these are both going to be operating type expenses. So if we add up the 172,700 plus the 157,000, that's going to give us the total operating expenses of 329,700. We're now in this outer column. We left off in the outer column at the gross profit. Now we're going to subtract out the selling, the operating expenses, which of course include the selling expenses and administrative, the 172,700, the 157,000, or the 329,700. So only two numbers we deal with here. Here minus here. That's going to give us the income before income taxes, 120,450, and then we calculate the taxes on it to give us the 72,740 bottom line net income. So it's going to be the standard type of income statement. Very useful, very good to tell us what happened in the past. Also great for grouping this information by the purpose. What did we have these expenses for in order to help us to generate that revenue? What's the category of what it helped us to do in order to get to that goal of revenue generation? What it's not good for is that projection into the future because of the grouping that we had to use in this format to group by what it's for. We had to group things that behave differently as we change the level of production. And therefore, when we project into the future and we start to do the analysis in terms of what if analysis, I would call it basically, what if we made this many units? What if we sold this many units? And we can have an infinite number of types of projections that we can have into the future. We can't manipulate this income statement as easily for those types of projections. It would be much easier for us to do so if we then grouped this type of financial data into more of a contribution margin type of income statement, a CVP analysis type of income statement, one that can be easily manipulated with very few factors to then change, that we can just basically automate the change as we go forward so that we can run many different scenarios. That's what we'll be comparing this traditional income statement to in future presentations. In this presentation, we will construct and analyze a contribution margin income statement. Last time, we took a look at a normal type of income statement, the type of income statement we would see in financial accounting, the types of groupings that we would see in financial accounting. We broke it out and constructed it from a trial balance. We want to keep this in mind when we consider a contribution margin type of income statement because we want to compare and contrast against it. Remember that this income statement, the normal income statement, is what we would consider in financial accounting, what we would consider in a normal, generally accepted accounting type principles or normal type of accounting, accrual accounting structure. However, we want to break that out into a different type of format, one we won't be used to if we've been working with financial accounting, because this is a managerial accounting tool, which means it's not required for external users as is the normal type of income statement, but can be useful, and therefore we need to analyze whether or not the added information would be useful or benefit to us for decision making. And what we're going to do then is take this same information, we'll construct it from the same trial balance, we'll get to the same type of net income, but instead of breaking this information out by category, what we're using this information for, or what these expenses are for, by grouping of their function to help us to get the goal of generation of revenue, we're going to be breaking them out by behavior, how they behave. That makes it a lot easier for us to do projections into the future. So keep in mind the grouping here by function. Cost of goods sold, that's what it is. Inventory that we sold. Selling and administrative expenses, selling, that's what it's doing. The sales type of items, the administrative, that is what it's doing. Now we're going to move to the contribution margin income statement, and we'll talk about it broken out not by what we're doing, but once again by the behavior. So we have the revenue. It's still going to be starting off with the top line. We have the revenue, and then we're going to have the variable costs. This is not something that you'll see on a normal income statement. We don't have variable costs broken out on an income statement. It is a managerial accounting type of concept that we will be using for projections. And it means, of course, that we're looking for those expenses. We're taking all of these expenses, we're going to break them out to variable or fixed. And we're going to be very specific on that. We want to make it variable fixed. Any other costs that behave differently, we're going to try to break them out. We will break them out in some format into variable or fixed. And that means that we're going to have to do some estimates to do that. But for now, we're going to make it a clean break. We're going to say everything fits into variable or fixed costs. And the variable costs will change with the level of production in a standard format. So they'll go up by a fixed amount for each level of production, down by a fixed amount for each level or increase or decrease of production. And so we're going to say that the direct materials then are going to be part of the variable costs. They will increase and decrease with proportion to the level of production that we have. The direct materials here. And then we're going to include the direct wages. So the direct wages are also things that we're going to say here, increasing and decreasing with an increase and decrease with the level of the production. Now, don't get confused here, because you might think, well, this looks a lot like the normal financial statement with these two items up top, kind of towards the top in what we would call before cost of goods sold. This isn't cost of goods sold. They happen to be in the same area because those are the things that are in production and therefore change with relation to changes in the amount of production. The next item then we're going to have here is the sales commission. And the sales commission is not something that we're used to seeing up here on the top of an income statement, because it has nothing to do with cost of goods sold. It usually goes into selling and administrative. But this time it's variable because it's sales commission. It's commission, meaning it's going to be changing as we increase or decrease the level of production and sales. And therefore it's going to be up here in the variable costs section. Odd, because it's not grouped by what it does for, it's grouped by what the function of the cost is going to be. And again, why would we do this? We'll see this a lot more clearly when we start to do projections into the future, but we'll see that by grouping these by behavior, it will be beneficial to us for projection purposes. That'll give us the total variable costs, which is going to be the direct materials, the direct wages, and the sales commission in this case, giving us the breakout of the $730,800. Then we're going to have the contribution margin. Again, this is something that we'll be familiar with once we start to look at this analysis, not something we've seen in financial accounting. It's not on normal financial accounting, because typically around this area, we would expect to see something called gross profit, possibly. Not the same thing, not even related, totally different things, because we're breaking this out in a different format. They both do start in the same area, sales versus revenue here. But in a normal income statement, we would then have the cost of goods sold. Here, we have the variable costs. Revenue minus the variable costs gives us the contribution margin. And the next item we're going to have then are the fixed costs. So fixed costs, remember, are those costs that do not change with the level of production. So the normal type of fixed costs we're going to have, the most common one I would say is the rent. The rent is going to be fixed. It is what it is. We can produce a lot more. We can produce a lot less. We're going to have the same amount of rent typically up to at least a certain level that we might have to increase or decrease the rent. But for the most part, same amount of rent. So the fixed costs, we're going to say here are going to be the taxes on the factory. So the taxes on the factory, we're going to say are fixed. We got the maintenance on the factory. We're going to say that that's fixed for our example here. We're going to say that depreciation on the factory is going to be a fixed type costs. Lease on the factory is going to be a fixed cost. Admin going to be fixed costs. And then rent on the administration and rent on the sales office. And then the total fixed cost. Now, you might be thinking here, hey, this looks kind of similar to like a normal income statement because a lot of the costs we saw up here in the normal income statement are matching over here, not exactly, but a lot of the costs down here kind of match up not exactly that we saw in the normal type of income statement. Why is that? Well, it's because basically the variable costs tend to be things that change with the level of production. And on a normal income statement, what would be up top is going to be the cost of goods sold, the grouping of what we do for production. But they're not the same categories. The grouping on the normal income statement is cost of goods sold. We're grouping by those things that we're using to put into the cost of goods sold. The things that would differ there, like the things that have fixed costs, oftentimes would be like the overhead would be included in the cost of goods sold, and over here it wouldn't be because it would be down here. So things like the rent on the factory and stuff like that are fixed costs. So note they're not going to be the same thing, even though we saw these two items up top, direct materials and direct wages, in the variable costs on the contribution margin, in a similar place that we would see under cost of goods sold on the normal kind of income statement. Here, they're here for different reasons by behavior. And down here, we have a similar characteristic in that administrative salaries, our administrative costs and sales costs that we see in a normal income statement are usually fixed. And therefore, we see them here as well on this bottom part, not because they're operating expenses types of grouping or selling and administrative grouping, but because they happen to be fixed, and therefore on the bottom part of this contribution margin income statement in the fixed costs area. So they could, you might, in other words, see some of these costs in similar areas just in location on the income statement and start to think that that means something. And it doesn't really, except for the fact that they happen to behave in a similar fashion that lands them on the same kind of location in terms of approximate location on an income statement. Okay, so that's going to be the total fixed costs, and then we're going to have the contribution margin where we left off in the outer column minus the total fixed costs gives us the income before the income taxes, then the income taxes, then we end up at the same bottom line number, that $72,270 that we ended up on in the normal type of income statement. So we end up in the same place. Why would we do this? You might look at this and say, this doesn't give me a lot of information that the other type of income statement gives me, because I can't give a relationship between, say, the gross profit and the sales and that kind of thing. But what we can do is now start to think and project forward and say, well, what would happen if there's changes in production level? And that's what we'll get into later. That's really what we can do here when we're making stuff, when we're going to have changes, when things are moving, when we're trying to figure out, well, what if we do this? What if we do that? A structure like this allows us to make those projections much more easily. We'll start to look at the calculations that will help us do that in the future. In this presentation, we will discuss mixed costs. In prior presentation, we discussed the concept of breaking out costs, not how we normally see them on the income statement by their function, by what they're due, by what their purpose is, but instead by behavior, by how they act. And we had two standard categories about how costs act. We grouped things into two standard categories, those being variable costs and fixed costs. Variable costs being things like materials, which will go up with production level, down with production level, and those things that won't go up or down with production level, for example, the rent. So if we had something like the units here, units increasing as we increase the units of production, we see that variable costs will go up, such as direct materials will typically go up because it's going to go up with an increase in the production level. However, fixed costs like the rent, as the units go up, stay the same. There we have that 20,000. Total costs then have a variable and fixed component to it. So we've seen this in prior presentations. If we were to graph this then, we could see it clearly on the graph here. This 20,000 represents the fixed cost, this red line being the fixed costs that are staying the same as the production level increases. The red line stays the same. The variable costs start at 0, meaning if we don't make anything, then we don't have any variable costs, and they're going up at a constant rate in this example because they're going up as we go up with production, each new item giving a fixed level that will increase at a constant slope in this case, and those are the variable costs. Total costs then start at the fixed cost area because, of course, at 0 production level, we still have to pay the rent. And then they're going to increase at a standard level in relationship to the increase in the variable costs. So this would be this is nice and neat. It's easy for us to see in this format. However, there is the fact that we can't normally break out all costs between this nice, neat, fixed and variable costs. Sometimes we're going to have what's known as mixed costs. And we're going to have to go through all of our costs, all of our expenses and say, is it variable, is it fixed, or is it mixed? If it's mixed, then we're going to have to do something to it to break it out to its components. So mixed costs could be something like wages, because wages, we know it's going to have maybe a salary component. We're going to have part of the wages that are salaries, and we might have part of the wages that are commission. The commission is more of a variable cost. The salaries are more of a fixed cost. So we might have other kind of variables involved. So when we look at just the expense item, we can't just say, well, that cost is variable or fixed. It's going to be mixed in some format. We're going to have to do some work there then if we want to break it out into the components of the two, which we do, which are variable and fixed for the CVP analysis. Utilities might have a different breakout for different reasons. So it might have a fixed base amount. For example, if we don't do anything, we might have a base amount of utilities. We still have to pay some utilities, possibly. And then it might go up at some type of fixed or variable type of rate after that point. So it might act as a variable at some point. So you can see that then when we think about these mixed costs, in other words, we're going to have to go through all of our costs, first of all, and see where they categorize them. Are they fixed? Are they variable? Are they mixed? And then we're going to have to go look at those mixed costs and look how they behave. How can we break these out? Because that's what we're going to want to do between the fixed and variable portion of these mixed costs. And as we do so, we need to consider what kind of things we'll probably see there. Something like this, where wages acting a little bit differently than the mixed costs of utilities. All mixed costs, in other words, are not going to be the same. What do you do for the CVP in the terms of these these mixed costs? We separate them as best we can. It is not a perfect world. Accounting is not a perfect world. We're going to have to be using estimates. We're going to have to go into these mixed costs and say, okay, we can't do mixed costs. They're too confusing. We don't want to deal with them. We need to break them out between fixed and variable. That's what we have to have for our contribution margin income statement. Mixed costs don't fit in there at all. So we're gonna have to break those out somehow. It's not going to be perfect to do this. So we're going to have to go through all of those mixed costs and try to figure out how best can we do that. And there's certain methods to do this. Now remember, these methods are not generally accepted accounting principles. They're not written in stone anywhere. These are best practices for us to try to consider how best we can break these out so that we can do the work of projections into the future, which of course in and of themselves are not perfect. They're estimates, they're projections into the future. So financial accounting is more about us taking something that already happened and reporting it in accordance with a certain set of rules. Here we're projecting into the future. So we're trying to think, what's the best thing we can do? What matters in terms of our decision making? What doesn't matter in terms of our decision making? How can we break these out in some type of way that's a good estimate that will help us for decisions, but also doesn't cost too much for us to be grinding these numbers out forever? Right? We can grind numbers out forever. So one way that the mixed costs could be broken out is we could have a stepwise type cost. And this might be something like salaries. We might see this in salaries where the salaries act kind of variable for a while, and then they plateau and they become fixed. So we might see in terms of administrative salaries, this might happen, where it's fixed for a certain amount because they have salaries, and then maybe at some point in time there's bonuses, or maybe at some point in time after a certain production level, then there's a salary increase or something like that, and therefore we see this kind of step pattern for those type of costs. Well, when we see that type of pattern, we can say, okay, we see this type of pattern, we can predict that type of pattern, we can take that into consideration when we consider our forecasting into the future, our projections. We can usually treat it then as either fixed or variable by analyzing this pattern and thinking about, okay, is this the relevant range when we're talking about a variable type of range, or is this the relevant range that we're thinking about in our projection that's a fixed type of range? And therefore, within our analysis, we may be able to break out within those ranges, whether it be fixed or variable. That's one way we can kind of step or treat a certain type of mixed costs when we see this type of pattern. We also might see more of a curvilinear type of cost pattern. In other words, it's not going up in a straight linear line, but instead it's got a shape to it, and that's going to have some changes. So now it's not as easy to deal with. Obviously, straight lines are a lot easier to deal with. So now we see that as this goes up, as the units go up, the mixed cost is going up, but it's not going up at a standard amount. It might be something like direct labor is where we might see a pattern such as this, because the direct labor can be a little bit confusing. Of course, it's not completely straightforward. We might be paying someone hourly as they make the production levels, but things can change within the production level. For example, if we start hiring people, the first people that we hire will typically increase our production level more quickly, and then at some point it'll flatten out. If we hire more people, then they won't increase the production level quite as quickly. And then at some point in time, of course, if we hire more people, they'll actually get in the way of each other, and our productivity won't increase with more people that we hire. So in that case, then, we're not going to see possibly this straight line variable cost system in a curvilinear type of cost system such as this. We're going to have to figure out then, because we want to graph in terms of a straight line for the CVP analysis so that we can make a nice, easy type of analysis. So in cases like this, we have this kind of funny curvilinear mixed costs. We're going to have to figure out some kind of ways, well, how can we break this out into such a way that make it strictly variable and a strictly fixed type of portion? That's what we'll need to see, more of a linear type of fashion, so that we can put this into a contribution margin income statement so we can use projections into the future. We'll discuss a few ways to do that in future presentations. In this presentation, we will discuss scatter diagrams, how to use them, how to create them. Scatter diagrams are going to be used as one tool with relation to the mixed costs. You'll recall that the mixed costs are those costs that we couldn't break out between the variable costs and the fixed costs, and they have some components of both variable and fixed in their nature. Things like we said, wages could be possibly a mixed cost, or utilities in some cases might be mixed costs. Those times when we have both fixed and variable components, we then need to break out the fixed and variable components. There then is the question, well, how do we do that? How do we think about what is fixed and what is variable? One way to do it is just to plot some points on a graph and think about and look at what those points look like with relation to that graph. So here's some numbers with relation to units produced and utility cost. And this, if we plot these points, if we say, okay, this is January, February, March, units that were produced, and we then graph utilities in relation to it, we can then plot those points. Now, note what we've done here is we have these points in terms of the date. They're in order by date. We could reorder this grouping of number to be in order by units, and we would then see that, of course, as the units go up, then the cost goes up to some degree in some kind of relationship. However, the relationship is not linear in nature. It's a little bit off. It's pretty straight. It's almost a straight line, but it's not completely linear. So this is one that's pretty close to having a nature that we can at least say is going to be a linear type of nature. If we were to graph a line on this, then we could say, okay, here's the full diagram of it. We're just taking these points and plotting these points. This is going to be the dollar amount on the vertical axis. We have the units on the horizontal axis. And of course, you can see at 100, we have 100, and that's at 5,250. And then again, it doesn't go quite in order in terms of the units of production. It's at 190 here, somewhere up here. And then we've got 7,860, 7,860, and then it goes to the 110. But you can see that as we go up in terms of units, we have an increase typically in the dollar amount as well, although the slope is not exactly the same. If we were then to draft a line that would approximate what we think would be the trend line of this set of data, which here is going to be pretty straightforward because the data points line up pretty close to the straight line, then we could just put the trend line in place, and that trend line can give us a lot of information about this data. So we can then, once we have the line, get the slope of the line, and we can get the formula for the line. So the formula for the line then would be y equals 29x plus 2,350 in this case. Once we then have the formula of the line, we can determine when this line will hit the vertical axis. And at that point in time, that's going to be the fixed cost, because that will be at the point where we have 0 units being produced, still have some cost. That cost must be the fixed portion of this type of expense. So how do we do that? We set the x to be 0 to the line, and then we solve the equation. So y equals 29 times 0 plus 2,350, y equals 2,350. So in other words, if we were to extend this line out, then it's going to hit the vertical axis at 2,350, and that then is what we would think would be the fixed portion of this mixed cost. Now, if we were to see a scatter diagram that would be looked a little bit more crazy in terms of where the points line up, there's not so linear in nature, it might look something like this. We might see scatter diagrams that aren't so linear for whatever reason. And we could do the same type of thing. We just happen to have some data that doesn't quite line up in a linear fashion as we would expect. We could look at this detail and try to figure out why that happened. We can try to think about, what's this kind of outlier type of points that we have in the scatter diagram. But if we take that set of data, then we could still do the same process and add our trend line to what we think is the best representation of that set of data. So we're going to have to say, there's the set of data. We're going to put a trend line because we need a linear line here. And now it doesn't line up too closely, or it's not approximating or touching all the dots here, of course. But we're going to still try to create the best line that we can. We can do the similar process with this once we get that trend line. And we will show, if you take a look at the examples, how to do this in Excel. We can plot this. We can make the graph. We can use Excel to give us our trend line. And we can use Excel to help us to get a formula even. Although once we have the line, we can get the formula for a line, which in this case is going to be y equals 27.567. It's not exact, x plus 2617.9. And once we have that, once again, we can take that line and extend it to the vertical axis. We can use a formula to do that. Y equals 28x plus 2618. We could then make x 0 and solve for y, which of course would be 2618. So if we extend this out, then we're going to say this is going to be somewhere about 2618 where it hits the vertical axis. And that again is what we would assume would be the fixed portion, because if it's at 0 and we still have 2618, that must be our fixed cost. We're going to say, well, that's going to be the fixed portion, and then we can try to estimate or approximate what the slope of the line is with our line, which is going to be our trend line in our scatter diagram. Hello, in this lecture we're going to talk about the high-low method. At the end of this, we will be able to explain what the high-low method is and why we use it, and calculate an estimate for variable cost and fixed cost using the high-low method. So we're going to work through a problem using this data set on this side. So we've got the months, we've got the sales data, we've got the total costs, and our objective, the objective of the high-low method will be that we have the total cost here, but we don't know what the variable cost or fixed cost portion of that total cost is. This is a common problem when we try to think of managerial accounting. Remember, we're often trying to say, okay, what's the variable costs, what's the fixed cost, and we want to break them out by behavior so that we can more easily make projections and estimates by treating cost by behavior. Now, in an ideal world, we would know exactly which costs would be variable and which would be fixed, but in reality, of course, there are a lot of costs that we don't know exactly what the variable or fixed portion is, and we can then use some type of estimate because we still really want to use the variable cost and fixed cost in order to make projections. So in order to do that, we can then try to figure out what the estimated portion of a variable portion and fixed portion would be on a cost, and we can use the high-low method in order to do that. So what we're going to do is we're going to break out these costs, so we're going to look for an estimate, a way to break out the variable portion, And then once we know the variable portion, we of course then can figure out what the fixed portion is, those being the two portions of the total cost. So in order to do that, we're going to use the high-low formula. The high-low formula is going to be the cost at the high point and minus the cost at the low point. So if we're looking at the cost over here, of course, these will be the high point. The 249,136 is the high point, and the low point is the 61,000 here. And then we're going to take the over divided by the volume at the high point. In this case, we're going to use the sales dollars minus the volume at the low point. So we're using sales dollars in order to drive this calculation. And of course, that will be the 356,000 at the high point and the 75,200 at the low point. So we're going to plug this information into our formula. Note that we're taking the high point and the low point, and we're kind of doing like an estimate. So if we get the thing right at the high point and the low point, and we come out to, in this case, we're going to come out to the same fixed cost number, then we're going to say, okay, that's a pretty good estimate for this particular type of cost. All right, so let's plug in the numbers. So the cost at the high point is going to be this 249,136. So if we look at the cost in this data set, of course, we're taking the high number, which will be this number here. And then we're going to subtract, according to the formula over here, the cost at the low point. And if we look through the cost on this data set, we come up to this 61,000 here. We're going to divide that by the volume at the high point, in this case, volume being in sales dollars. And of course, that's going to be this 356,000 here minus, and then we're going to have the volume at the low point being this 75,200 here, and that's going to be there. Then if we do the subtraction in the numerator and the denominator, we say that 249,136 minus the 61,000 is 188,136. Then we subtract the denominator, the 356,000 minus the 75,200 will give us the 280,800. Then if we take this and divide it by this in a calculator, this divided by that, we are going to equal the 0.67 or 67 cents. So that's going to be what we're going to use then in order to allocate the variable portion. So we're going to say 0.67 of the volume, in this case being the sales dollar, will be the variable portion. And then once we figure that out, we can then subtract the total from the variable portion to get the fixed portion. And we'll do that calculation for the high point and the low point, and we will hopefully come out to the same calculation for the fixed portion. That's what we would expect. The fixed portion is going to be fixed at the high point and the low point, and should therefore be the same. All right, so we're going to then calculate the high-low method. We're going to calculate the high point to see how the allocation could work, and then break out what the variable and the fixed cost would be. All right, so here's the high point. So we have the total cost of the 249,136. We want to break that out between a variable portion and a fixed portion. In order to do that, we're going to do the variable cost at the high point calculation. So we are going to do that, we're going to take the volume at the high point. So that's the volume in terms of sales dollars here. That's where we come up with this 356,000. We're going to multiply that times the variable cost per sales dollar. That's our calculation up here. Variable cost per sales dollar gives us that 0.67, and if we multiply this 356,000 times the 0.67, we come up with the 238,520. That's the variable portion of this total cost. That's the variable portion. Therefore, if this is the total minus the variable portion, the only other piece being the fixed portion, subtracting those out, we get the 10,616 fixed portion. So now this total cost is broken out between the variable portion, the 238,510, and the fixed portion, 10,116. Now, if we do the same method if we do the same calculation for the low point, we're going to come out to the same fixed cost, although variable cost will change. So let's do that. We're going to say the low point then, same calculation. There's a very less in terms of total cost, the 61,000. We want to break that out between the variable portion, fixed portion, same calculation. We're going to take the variable cost at the low point calculation. So we're going to take the volume at the low point. That's the sales dollars in this case, the 75,200. We're going to multiply that times the variable cost per sales dollar, the 0.67. And if we multiply that out, we get the total variable cost at the low point, 50,384. And if this is the total cost, if that's the variable portion, then we subtract those out to get the fixed portion being the 10,616. So it's the same at the high point and the low point. That's why it's kind of an average that we can use. So we can kind of use it at any point because we're estimating that it's basically good as the average on the high and the low point. So we can see that comparison here. We can see that at the high point we have a much larger total cost than at the low point. And we can see that the variable portion, of course, is highly different. That's what's going to change. The fixed portion is what is remaining the same in this calculation. That's what we would expect at the two extreme points using this high-low method. In this presentation, we will discuss the contribution margin per unit, and the contribution margin ratio. We're going to start off with the contribution margin per unit. These are going to be similar concepts. They're very related, but they can get a little bit confusing to consider what the contribution margin is, what the contribution margin per unit is, and what the contribution margin ratio is. They're all related. They're all similar in some ways. We'll start with the per unit because that's going to be what it is in its basic building block type format. So the contribution margin per unit is the amount by which a product's unit selling price exceeds its total variable cost per unit. So once again, we're considering on a per unit basis here what we have in terms of the selling price, and then that will be compared to, that's going to be what's coming in, what we're getting, as compared to the variable cost per unit, and that's what's going to be going out. So obviously, if we think about this per unit, if we're selling things like a coffee mug, we're saying what's going to be the selling price for that particular coffee mug, that one piece of inventory that we sell, and then what's going to be the variable costs, not the fixed costs. We're not talking about normal kind of financial accounting terms where we're saying everything that goes into the production of the inventory. We're not talking, in other words, of the cost of goods sold of that inventory unit, only the variable costs, the variable portion, because those act in a similar fashion. So remember what we're doing here within managerial accounting is we're always breaking things out by the behavior of the cost. And you might be saying, well, that's going to be an inaccurate number, because if you think about financial accounting, you're going to be saying, hey, what I'm really gaining from the sale of that should be including everything in this cost to give me basically the gross profit of the sale per unit. In other words, variable costs shouldn't be it, because it's not going to be included everything, and you might say it's not including things like overhead, which are oftentimes the fixed portion that is still necessary to apply to the production. However, we'll see that the contribution margin, just basically the sales price over the variable component, will be a very useful calculation when we think about managerial accounting and types of decision making related to it. Also note that we've also seen this contribution margin, not contribution margin per unit, but contribution margin when we looked at the contribution margin income statement, which was the total revenue or total sales minus the total variable costs. You'll see after this is going to be, in essence, the building block that will get us to that point. We'll be able to take the contribution margin income statement, in other words, and break it down to its components with the use of the contribution margin per unit, with the use of the number of units that we sell, and we'll be able to go the other way as well. We'll be able to take the contribution margin per unit, look at how many units we're going to sell, and be able to make predictions of a future contribution margin income statement, or a projected contribution margin income statement. That's the power, that's the use of a calculation such as this. When we think about the contribution margin, then again, we're thinking about the contribution margin and the contribution margin per unit. First, we'll think about the contribution margin, which is going to be the sales. We're talking total sales now, not per unit. And then we're going to have the variable costs, total variable costs, as we saw in the contribution margin income statement. If we take sales minus the variable costs, that gives us the contribution margin. Now note, when you see the contribution margin and when you work with it in something like a spreadsheet or a spreadsheet program, you're often going to see it in this format because you want to calculate the contribution margin and then think about, well, what's it going to be the contribution margin per unit? And so, or we might see it the other way around. We've got the units and then we'll see the contribution margin. But in any case, notice that when we see this line item here, it's going to say contribution margin or contribution margin per unit, because it's representing this two lines. So in other words, if you make a financial statement, the first line is going to have to be one or the other, contribution margin per unit or contribution margin, and then the other line is going to have to be contribution margin per unit or contribution margin. So that's why these terms, they can get a little bit confusing when you try to format your spreadsheets and how you're going to be putting this together. So just be aware of that. Now we're talking about the contribution margin per unit over here. we're going to say that the sales are going to be $57 per unit. That would be given. We would know that because we would know how much we sell, in our case, the coffee mugs for. And then we have the variable costs of $30. And again, we would know what the variable costs are because we broke that up in our CVP analysis. We know the variable components of our costs. And if we subtract those two out, the 57 minus the 30 gives us the 27. So we have the contribution margin in total. We have the contribution margin per unit. Now we need to consider what the contribution margin ratio is. So now another word with a contribution margin in it. So just note they're all similar, they're all related. However, they're slightly different. So you want to make sure, are we talking the contribution margin? Are we talking the contribution margin per unit? Or are we talking the contribution margin ratio? Here, contribution margin ratio is percent of units selling price that exceeds total unit variable cost. Once again, percent of units selling price that exceeds total variable costs. How would we calculate that? We're going to take the contribution margin per unit and we're going to divide that by the selling price. So remember so now we got the contribution margin per unit. What was that? We just looked at it. Contribution margin per unit is the selling price minus the variable costs per unit. So the selling price per unit minus the variable costs per unit. That is the contribution margin per unit. You're going to take that and divide it by the selling price to get the contribution margin ratio. Now, when you consider this, you're probably going to have a similar table like this, and you're always going to be building these tables, and you might as well just build them all out, especially if you're using Excel, so you get an idea of setting these tables up, how to calculate these, what the relationships are between them. So we had last time, we had the contribution margin, where we have the sales, the variable cost, the contribution margin in total. We also have it in units. So if we have the units over here, then we can look at our formula and we could say divide that out. We get 0.47 in a decimal format, or 47%. In other words, you're going to see your table here and we're going to say, all right, now we see what the contribution margin is, which was the sales minus the variable cost, contribution margin per unit, 27. So we'll take that 27 and we'll divide it by the sales, which is 57, divided by 57, and that's going to give us, it's not exact, but 0.47, so we've rounded here, so be aware this is rounded. And then if we move the decimal 2 places to the right, we're going to get that 47%. Now, note that we always concentrate on the contribution margin most of the time, but what we're really doing here is a similar kind of ratio analysis that we would see on an income statement. This is similar to what we'd see in an income statement, which would be income minus cost of goods sold. This is going to be similar to a contribution margin income statement type of calculation, where we have sales minus the variable costs to get to the contribution margin. So just note that we're comparing everything to sales. So we compared the 27 to the sales. We can do the same for the 30. So if I compared 30 variable costs per unit to the sales divided by sales, we get 52.6 or about 53. And again, if I move the decimal over, 53. And of course, 47 and 53 is going to add up to 1 or 100%, or sales over sales. 57 divided by 5, or let's say 57 divided by 57. Okay, so also note that we could do the same thing here. We did this on a per unit basis. That's what our definition said. But of course, we could do the same thing with the relationship between the total sales and variable costs if, of course, the ratio is the same. In other words, every unit was sold for 57 and the variable costs were all 30, then the relationships will be the same. So we can, if we have our contribution margin here in total dollar numbers, we can then take, and let's keep this down here, we can take the 2679 divided by the sales 5700, which is going to give us the same number, of course, as the 27 about, this is rounded, over the 57. And so we get the 47. Again, be careful of rounding. Same kind of situation. And then if we take the variable costs, the 3021 divided by the 5700, that gives us the 53. And if we add those two up, we get the 100%. Again, given for rounding. 57 over 57 as well will give us the 100%. So you're always going to be wanting to build out these types of tables that you'll have, and this will be similar to a contribution margin type of income statement. Just again, be aware that you're going to be considering total costs, per unit costs, and when you think about these line items, then you're going to have to consider whether you're talking about which column you're having here to represent total costs and the per unit costs and the contribution margin percentage. It might not be as clear given the description because they're all going to be on the same line. You'll have to go to the headers up here to know exactly what you're talking about. You want to keep them distinct in your mind. The best way to do that is to calculate them all. Most of the time when you have these types of problems, you just do all the calculations and try to rework them and calculate them in different ways. So you get just a good idea of all the relationships that go on between these, how they're similar, how they relate to each other, the similarities and the ratios between the per units and the totals. Hello, in this lecture we're going to talk about the contribution margin income statement. At the end of this, we will be able to create a contribution margin income statement from a trial balance, create income statement from a trial balance, a financial income statement, compare and contrast the contribution margin income statement to a standard financial income statement, and calculate the contribution margin per unit. Okay, so we're going to have the trial balance over here on the left-hand side. We're going to start off with a normal financial income statement. Reason being is because we want to compare and contrast the two, so I want to start off with what we know, then move on to the new thing, the contribution margin income statement. On the left-hand side, we have a trial balance, which has a very limited balance sheet portion, which only has the cash and the accounts payable and retained earnings. Everything else is related to the income statement. So we have revenue, on down, all the expenses related to the income statement. Net income is $72,270. That's going to be the revenue minus the expenses. So we already know what the bottom line number of the income statement will be. That's going to be the same for the normal income statement as well as the contribution margin income statement. The thing that will differ is the categorization. The normal income statement is going to categorize by what the expense is for. The contribution income statement is going to categorize by the type of expense, the behavior of the expense, variable versus fixed. And there's different reasons for the two of those. Remember that the income statement financial side, that's what's going to be due for generally accepted accounting principles. That's what external users want to see in terms of the big picture. When we think about contribution margin income statement, we're usually thinking about internal use, managerial accounting, internal use, because it really helps to make projections and things like that. Also note that I'm going to basically have the expense for direct materials, direct wages, and like factory overhead type stuff. So we're expensing it in real time as it happens, and the assumption being that basically we're taking the job and we're expensing it and selling it at the same time. That's why these are going to be included in cost of goods sold, rather than what we would kind of do in a job cost system, which is basically put it in the work in process, then finished goods, and then expense it when it's sold at a later time. And the reason for that is because I want to group out what's in the cost of goods sold by what's in there, so that we can kind of see what's making up the cost of goods sold, which is going to be the direct materials, the wages, and the overhead, as compared to the contribution margin income statement, which isn't going to be grouping in the same way. So let's find a home for all these. We're going to say the revenue is a credit here. We're going to put it on the statement as just a positive number. Then we're going to calculate the cost of goods sold. Normally, it would be always calculated as beginning inventory plus purchases, or in this case, cost of goods manufactured minus the ending inventory. But here, remember, we expensed everything because we're kind of assuming that we did it at the same time, meaning we did the work and then sold it in the same time period. And therefore, we're going to put the components of what makes up cost of goods sold. Remember, cost of goods sold is the inventory we're selling. That is made up in one way or the other by the direct materials. Direct materials and direct wages, that's what's being put into the cost of goods sold, the inventory that we're selling. Notice that those two are generally variable costs, meaning they change in direct proportion to the number of stuff that we're producing. And then we have the overhead, which oftentimes is the fixed cost. So note that the behavior of these two costs are going to be different, but we're grouping them not by behavior, we're grouping them by category. In this case, the costs related to the inventory that we're selling. Now, what would be grouped into something like overhead? Not sales commission. We would have the taxes on the factory, anything that says factory on it. So maintenance on the factory, so I'm going to put a dot here. We got the depreciation on the factory, lease factory equipment. So those are all types of things that would be included or could be included in the overhead. So if we add those up, we'll bring the calculator over here and see if we can add those up. We've got the 13,500 plus the 27,000 plus the the 87,000 plus the 27,000 gives us the 154.5. So there's that 154.5 there, and that will give us the total cost of goods sold. So here's the total cost of goods sold. Once again, we're just showing the components of it: direct materials, direct labor, overhead. We're breaking this out by category, in this case, cost of goods sold. That'll give us the gross profit. The most important number on the financial statement is the comparison of the revenue to the cost of the stuff that we're selling. That's usually the most important comparison. That's what the users of the financial statements really want to see. We break out the other expenses in terms of operating expenses, which would be selling expenses and administrative. Selling expenses in this case consists of sales commission. And notice that sales commission is a variable cost because it's going to change with the number of stuff that we sell. So it behaves more like direct materials and direct wages, and unlike kind of a lot of the stuff in overhead, which is kind of fixed. But we're breaking it out by category, not by behavior of the cost. We have the rent on the office sales, rent on office here. We have then the total selling expenses. We add these two up, so the 95.7 plus 77,000 equals the 172.7. And then we're going to have the administrative expenses. Administrative expenses will include the administrative salaries. So administrative salaries here, that'll include the accounting in this case. And then we have the rent on the administrative office, which is the 50 here. Notice we found a home for everything on the income statement, all the dark blue numbers except for the income tax. That's usually going to be calculated at the end because it's going to depend on the net income. So that's going to give us the total administrative. We're breaking these out in this column now. So that'll give us the total operating. So total operating being broke out over here, being this number plus this number. And then we can get the income before taxes, which is the 150 minus the 329.7. That'll give us the 120,450. Again, we often break out taxes at the end because we're going to calculate the taxes based on that number. And if we put it in somewhere else, it kind of distorts taxes. But we broke it out on the trial balance here so we can see it there. And problems, you're often going to see something say like calculate taxes between a 30 and 40% tax rate on that. I believe there's like 40% tax rate of the 120,450. And then we could say if we subtract that out, we get the 72,270. That matches what we have here, 72,270. Now, remember, this is grouped by category, meaning the cost of the inventory, the operating expenses being selling, and administrative, not by the behavior. We've got things that are variable and things that are fixed in most of those categories, as opposed to the contribution margin. So note the contribution margin income statement is going to end up at the same spot. We're going to have the 72,270. What we want to do, though, is break it out not by category. We want to break it out by behavior of the cost. Why? Because behavior of the cost is something that we could really help with projections, and that's what we'll take a look at in the next when we talk about the contribution margin per unit. But so that's why we're doing it, and we'll take a look at that more later. We're still going to start off with sales, of course. So we're going to take these same numbers, we're going to stick with sales, but instead of having cost of goods sold, we're going to talk about variable costs now. Variable costs by behavior, not by category. So variable costs being the direct materials, the direct labor, and the sales commission. So that's kind of funny that we have, stuff that's related to making the inventory and stuff that's related to selling things and not included in the creation of the inventory in the same group. That's funny for financial statement purposes, but it makes perfect sense for projection purposes. So if we add those up, we have the total variable cost of $730,800. And then if we take the look at the then we get the contribution margin. That's going to be the sales minus the total variable costs. That gives us the contribution margin. So gross profit being the most important number on the normal financial statements, contribution margin being the most important number here, because that's going to be the relationship between the sales and the variable costs. And we'll see the contribution margin per unit will also be quite important. So then we have the fixed costs. Fixed costs being the things that will not change with the level of production, and those include the taxes on the factory. We're assuming that's going to be fixed, like sales tax or something like that on not sales tax, property tax on the factory. And then we've got the maintenance on the factory. Again, we're assuming that's fixed. We actually said so here. And then we're saying the depreciation and the lease on the factory equipment. as well as the administrative salaries. Notice once again that we're talking about costs that are all over the place here. We're talking about stuff that's included in inventory, would be in cost of goods sold, and stuff that's in the administrative place here. And then we've got the rent on the administrative office, rent on the sales office. So now we have sales things in this fixed cost category. And then we have the total fixed costs here. Again, we found a home for everything except for the income tax, because that's always going to be broken out at the end. And we would come up to the same income before income tax, same number we had last time, that being the contribution margin less the fixed costs. And then we're going to get the income tax, and that's going to be this number here. And it's also like calculated as a percentage oftentimes when you look at types of problems. And then we're going to have the net income being the 124.50 minus the 48.180 income tax, giving us the 72.270, same number here. So we have the same number at the end of the day. If we were to compare this to the normal income statement, so here's the income statement, here's the contribution margin. The thing to note here is that we're coming out with the same number. We're coming out with the 72.270, 72.270, bottom line's the same. The breakout is what's different. What's different about it? Over here, we're concerned about the categories. The most important number is the relationship between revenue and the cost of those revenues. But the cost of those revenues used some estimates because we had to allocate both variable and fixed portions to get that number. So that's where the gross profit is. And then we had the categories of selling and administrative expenses. So we're grouping by those categories, and we're making decisions and looking at things in terms of that format. Over here, we're grouping by behavior. So we have the variable costs and the fixed costs broken out. That's going to be the grouping. Variable costs and fixed costs within there will have things all over the place. It's got stuff that's from the production of inventory. It's got stuff from the selling and the administrative area. The reason we're going to do that for internal purposes, and remember this is for internal purposes, not for the external financials generally, is that it's going to help us with projections. If we start to assume that we're going to produce more or less, we know that everything up here is going to change at a standard rate. It's going to change at a standard rate. And we know that everything down here to a certain level is not going to change at all. It doesn't matter how much stuff we produce, and that makes it a lot easier for us to start making projections. So if we take a look at for example, the contribution margin per unit, we would have the sales per unit, so the sales per unit being this 285, and then we would have the variable cost per unit. So the variable cost per unit, if we pull out the calculator here, we're going to say the variable cost per unit are going to be the direct materials, which is the 247,950, divided by the number of units, in this case the units produced up here, which is the 4350. We're going to get the 57. So we got the variable cost per unit for direct labor, 57. And then if we're going to have the variable cost per unit for the direct materials was 57. If we take the direct wages, we take the 387,150 divided by the 4350, and we get the 89. So we've got 89. And then we've got the last one. Last one's a little tricky. It'd be the sales commission. And again, the sales commission's up here. That's something not normally we group together. We're not used to seeing those together when we think about the normal financial statements, because one's in cost of goods sold and one is in sales, but they act the same way. So we're going to take the 95.7 divided by the 4350, and that's the 22. All right, so then if we have these added up, that's going to be the total variable costs. And then if we take the costs of the sales price minus the variable cost, we come up with the contribution margin per unit. And the reason that's really important to be thinking about for anybody, I mean, even if it's like a hot dog stand to a large business, the idea is, well, how much does it cost per unit? How much am I getting per unit? I'm selling at a cost of 285 minus the variable portion. That means we're walking away with 117 after variable costs, things that change with the unit sales. Then you're going to ask, well, how many units do I have to sell in order to break even? So the break even here, you'd have to cover the fixed costs. Fixed costs being 388,500 divided by the 117, and that would give us we would have in this case 3,320. The contribution margin percent is here. That's going to be this number 7 over the 285, and that's going to be the 41. Of course, it's rounded upwards. Hello, in this lecture we're going to talk about the break-even point. At the end of this, we will be able to explain what the break-even point is and how it can be used, calculate the break-even point in units, calculate the break-even point in sales dollars. Okay, so we're going to have two formulas here. One's going to be the break-even point in units, and that's going to be fixed cost over the contribution margin per unit. And then we've got the break-even point in sales dollars, which is going to be the fixed cost divided by the contribution margin ratio. We can also have an alternative way to take a look at that one, which we'll take a look at as we go as well. Just remember, if you're looking at any problem, you're going to have to consider which of these are being asked. We're talking about the break-even point in units, and when we think about that, it's very important for a business to think about, well, yeah, how many units do we have to sell in order to break even? And then we can easily jump from there to think about, okay, well, how many units do we have to sell not only to break even, but to get an expected revenue percent? So this is a really important calculation, no matter what type of business we're running. Even if it's like a hot dog stand to a very large corporation, we still want to think about in terms of how many units do we need to sell really in order to achieve a certain goal, that goal being first breaking even, and then breaking even plus some type of profit margin. And then of course we can think about it in terms of sales dollars. Well, how much sales dollars do we need to make? And we can think about, well, how many units do we need to sell in order to hit the sales dollars, in order to hit that same break-even point, and then take it a step further in terms of break-even plus what profit we wanted to get walk away with. So let's break these calculations down. We have the break-even point in units first. That's the first one we'll take a look at. That's going to be the fixed cost. Remember, that's going to be like the rent for things that don't change, divided by the contribution margin per unit. And of course, the first thing we need to know is, well, what is the contribution margin per unit? We need to find that calculation. In order to do that, we will take a look at the data over here where we have the sales price, the fixed cost, the maximum capacity, variable costs per unit over here. We're going to use that information to calculate the break-even point in units. And in doing that, first we need to calculate the contribution margin per unit. All right, contribution margin per unit. We're going to take the sales price per unit. So whatever we're selling, we're saying that we're going to have a sales price of $310 per unit of every unit that we sell. We're thinking about like inventory. We're selling each piece of inventory. We're getting $310. And then we're going to subtract from that the variable cost per unit. These are usually the things that are the direct inputs, including the direct labor and the direct materials. These are usually the things that are directly within whatever it is that we are producing. And then we can think of, okay, so we're walking away with 124 of each unit. And then, again, this is going to be common for anything, even if we're selling things, even if we have just a hot dog stand, right? We can really think about, well, how much are we selling these for, and what's the cost to make these per unit? And we can think about, okay, that's how much we're walking away with after variable costs. And then we usually have to think about, well, then how many do we have to sell in order to pay for the fixed costs including things like the rent of the hot dog stand, possibly in that case. So same calculation for a large business too. We can try to break it down in a similar fashion to think about, okay, what are we walking away with per unit sales after the variable costs, and then think about how many units we have to sell to get to cover the fixed costs, and then tack on the profit. That's going to be the contribution margin per unit. So in this case, we're walking away with 124 after each unit that we sell in this case. Okay, and then if we have the contribution margin percent, also known as the contribution margin ratio, what we're taking is the 124 divided by the sales price. So 124 divided by the sales price gives us 0.4 or 40%. All right, so we're going to use these numbers to put it into our break-even point in units formula, which is the fixed cost divided by the contribution margin per unit. So the fixed costs over here in this case are the 421,600. And remember, those are the things that don't change. Those are things like the rent. It is what it is. So we're going to take that and we're going to divide by the contribution margin per unit. And so that's how much we're walking away with after each unit sales, after the variable costs, not including the fixed costs, but after the variable costs. And if we divide that out, the 421,600 divided by the 124, that means that we need to sell, in this case, 3,400 units in order to break even. So that's how many units we need to sell in order to just cover the fixed cost, basically the things like the rent. Next, we're going to calculate the break-even point in sales dollars. So we talked about how many units we need to sell, and now we need to think about how many dollars we need to bring in terms of revenue in order to cover both the variable cost and the fixed cost. Now, if you're like me, you're probably thinking, well, if we had the 3,400 units that we need to sell. We just need to know, well, how much are we selling those for? In this case, it's the $310. Therefore, we just multiply those two out, and that would be the revenue that we're going to pull in. And that's one way we could do it. That's one way we can think about it. We're going to do that on the next slide. But the standard formula and the way that it is often going to be useful to look at it in certain situations, depending on the situation we're in, would be to use the formula of the fixed cost divided by the contribution margin ratio. So the break-even point in terms of sales dollars is going to be the formula of the fixed cost divided by the contribution margin ratio. What's the contribution margin ratio again? Remember, we calculated that prior. We said I called it the contribution margin percent over here. That was the sales price per unit minus the variable cost per unit, gives us the contribution margin here per unit in this case. The contribution margin divided per unit divided by the sales price per unit gives us that 40.4 or 40%. That's the contribution margin percent or the contribution margin ratio. Now, if we had the totals here, if we had not per unit, but if we had the total sales minus the total variable cost giving us the contribution margin, we would have the same ratio because of the behavior of the variable cost related to the sales. So keep that in mind, that we could be using the per unit numbers, we could be using the total numbers, but if we divide the contribution margin or the contribution per unit divided by the sales price or the total revenue, we should come up to the same ratio, in this case being the 40%. Okay, so if we plug that in here, then we're going to take the fixed cost given to us here, things like the rent, $421,600, divided by the contribution margin ratio, which in this case is the 40%. And if we take this divided by the 40% or 0.4, we have the $1,054,000. So that's going to be the break-even point in terms of dollars. So here's the break-even point in terms of units. Here's the break-even point in terms of dollars. What's the other way we can think about that in order to calculate this? Well, if we take the break-even point in terms of units, the 3,400 units, and we multiply that times the sales price, the 310 as we discussed before, we get to that same number, that 1,054,000. So whichever way makes sense to you, you can use whichever method makes sense. But when you look at multiple choice problems, of course, it's very likely that the problem will be limited in such a way that we will only be able to use one or the other types of calculations. This is the calculation that will often be used. So if you have a multiple choice question and they only give you enough information to give you the contribution margin ratio, and they don't give you enough information to figure out maybe this number here, the sales price per unit, then you're not going to be able to do it unless you have this formula in your head and ready to go for that type of problem. So keep that in mind as we go. In this presentation, we will discuss, define, and calculate the margin of safety. We'll start off with the break-even point. We've seen the break-even point in prior presentations. We'll be using this to move on to our margin of safety calculation. The break-even point is going to have the fixed costs. We'll start with the fixed costs and then the contribution margin per unit. We can calculate the contribution margin per unit at the 5700. This is going to be the total sales for total sales minus the 3021. That's going to give us the 2679 contribution margin. I'm going to divide that by the number of units divided by 100. And that's going to give us about 27. So notice there is rounding here. It's really 2679 for the contribution margin per unit. Then that'll give us the break-even point in units, which is going to be the 2679 into the 153,900. Or, in other words, we can take the 153,900 fixed costs divided by the 26.79, and that's going to give us the 5744. Again, we're using rounded numbers here. And then we could calculate the break-even point in dollars by then taking that 5745, which is really 5744.68, multiplying times the $57, because it's going to be $57 per unit, because we know that we have the 5,700 sales divided by 100 units, the $57, and that's going to give us the 327,447. Again, Note that there is rounding involved. So we've got that break-even point then. Now we can take a look at the margin of safety. The margin of safety is defined as the amount that sales can drop before the company incurs a loss. So in other words, we've got that break-even point, and we want to see now, okay, where are we at and how much can we go down by? What's our margin of safety? How much can we go down by before we get into that negative territory, into that loss type territory? So this is another use. Remember that the break-even point is kind of our starting point for a lot of this CVP type of analysis. We got the break-even point. Now we want to think about that margin of safety type of calculation. To do that, we're going to take the expected sales. So we're going to say the expected sales are 500,000. And where did we get that number? That's going to be given in our problem or given in real life. We're going to know what the expected sales are. This is what we think is going to happen. We know the break-even point now because we just calculated it. That's where we're going to break even. The difference then between those two is going to be, in essence, our margin of safety. Now we can have the margin of safety that is expressed in a percentage as taking the expected sales minus the break-even sales number, giving us the margin of safety in dollars. Now if we take that number and divide it by the expected sales, we can express the margin of safety in units. That in this case, the margin of safety in dollars, 172,553, which is the 500,000 minus the 327,447, divided by the 500,000 expected sales. We then express it in terms of a percentage, 34.51%. In this presentation, we will discuss forecasting. Many of the tools that we've taken a look at so far, breaking out the variable cost, the fixed cost, the contribution margin per unit, the contribution margin ratio, are very useful for the skill of forecasting. Once we have this all set up, once we have the fixed costs, once we have the variable costs, once we can break this down to a fixed cost and variable cost per unit contribution margin, then we can do a lot of forecasting very easily. In other words, we could set this system up and put it into an Excel worksheet, and we can then make projections with very limited amount of adjustments to that worksheet. In other words, we can project, for example, what our sales volume is going to be increasing and decreasing, and let the worksheet basically make the adjustments for us, given the fact that we've put into our sheet the idea of fixed costs and variable costs. And since it's in the system by behavior, we can then let the worksheet do the forecasting work for us. And this is very useful when we start to think about, okay, what happens if we do this in the future? What happens if we sell more? What happens if we sell less? What happens if we want to adjust something like our advertising budget and we think that's going to increase more here and less here? In other words, fixed costs possibly going up, and then maybe we're going to sell more as a result of that. All these type of scenario type of analysis, a lot easier to do once we have this information down, once we have this information in the format of a CVP type of analysis, in the format of a contribution margin type of income statement. Here's going to be our information. Note that if you're talking about problems, they're often going to have the current information and then the future information. Note that when we're thinking about how to break this information down, we're going to have the financial statements, which are always built on something in the past. So we got the past financial statements. Then we're typically taking that information and projecting into the future. That's usually where we think about the CVP analysis. Now note that anytime we do that, we're going to take the past information into consideration. The past is what we have to go on to project into the future. But also note that the past information is not all that we have to go on. So we can't just take the past information, project it forward. So when you take a look at book problems, they're going to emphasize that a lot, and they may actually give you the past information and the future information. And just note that we're going to have to make that adjustment in the book problem and in real life. In a book problem, you're going to have to know that if you're talking about a forecasting problem, then of course you're going to take the estimates in the future to do your forecasting estimates, which will be slightly different than the past information from the prior year. Obviously, in real life, to forecast into the future, you're going to start with the prior year information and then do any kind of thought experiments you can have to think about how you're going to adjust that into the future. Is the price going to go up? What's going to happen? And if the price goes up, then possibly you sell a little less. Maybe you're going to increase the price and sell less, or maybe you're going to increase advertising and the volume will change. So these type of adjustments, of course, will be taking prior year numbers and then making the adjustments with it. So this is the current year sales and the current year variable cost. And then we have here The fixed costs, now these may be very similar from year to year because they're fixed, like the rent is the rent, typically going to be pretty similar from year to year. Then we have the estimated sales in units. This is the thing that we're typically going to change. So when we're thinking about the future, we're often going to be changing the sales units. And that's the thing that we want this to be set up so that I can basically change this sales units number and the whole worksheet will recalculate for us, give us a new net profit number because of the ease of it to do so because of the breaking out between the variable cost and the fixed costs. Then we have the estimated sales price and the estimated variable costs per unit. So if we consider our contribution margin income statement type format for our forecasting, this is our forecasting contribution margin income statement. We have the sales, so the sales are going to be in units. We got that 40,800 units, and that's going to be our projected units that we're going to sell. We're going to sell them for $208, so 208 per unit. 40,800 times 208 is going to give us the 8,486,400. Next, we're going to have the variable costs. So again, we're going to take the same 40,800 units, multiply that times the variable cost per unit. And again, we're going to know that because we're breaking that out in our CVP analysis. And we're going to say that the variable cost per unit are the 148. If we multiply the 40,800 times the 148, we get the 6,038,400. Then we can have the contribution margin, which once again, we can do this two ways now, the contribution margin. We can take the 40,800 in units, multiply it times the contribution margin per unit, the 208 minus the 148 or the 60. So 40,800 times 60, 2,448,000. Or we could take the total sales minus the variable cost, the 2,448,000. So we kind of double check our number in this way. The next item will be the fixed costs, and notice we're not taking now the 40,800 because the fixed costs it doesn't matter how many units we make, they're fixed, that's the point. So the fixed cost is going to go right over to the end. We're going to say 638. It is what it is, it's fixed, and therefore we just keep that as is. Then we've got the income before taxes, which is going to be the contribution margin, the 2,448,000 minus the 638,000 or the 1,810,000. Then we would calculate the tax, and we're just going to say the tax is 633.5, and that'll give us the net income. So that's going to be our base calculation. Now, of course, when we think about our forecasting then, this would be basically a static set. We're going to say there's 40,800, that's how many units we're going to make. Now, if we were using just a normal type of income statement and budgeting it out, then it would be a lot of work for us to do that with one set income number. But in this setup, we could say, well, what would happen if we made, different levels of units that were sold? What would happen if we sold 30,000? What happens if we sold 50, 60, 70? We can make that adjustment very easily by just changing this top part. The bottom part is going to stay the same because it's fixed. In other words, the fixed cost won't change, and these will change at a constant rate. That's why we broke it out between fixed and variable cost. So for example, if we change this number to 60,000, we're going to say, all right, now the units are 60, the variable 60, the contribution margin is 60. If we had an Excel worksheet, we would just say that these items are going to be pulling from that cell. And so that would happen automatically. So you can see we can just change this one number. It'll then multiply out in this format. These numbers will change automatically by just changing one cell in essence. And then it'll basically be able to recalculate the whole thing. So 60,000 times the 208, 60,000 times the 148, 60,000 times 60. And in essence, we've got the 3,600 contribution margins minus the same fixed costs. Those didn't change, they're fixed. That's why we broke the two out. That's going to give us our income before taxes, calculating the taxes on it, and then subtracting that out will give us our net income. So if we change it then to 35,000, same thing, which changes one item, it's going to change these automatically. These will change for us, and that'll pull right through and adjust these items to get to our bottom line number. So that projection item is going to be very easy. We can see other types of projections that we might make. We might have some adjustments we think are going to happen to the fixed costs. For example, if we say that we increase the advertising budget or something like that as a fixed cost, this could go up, and we would have to adjust the fixed costs with relation to that static increase, and then that could increase or decrease the estimated sales price. But just note how much easier it is to do this than if we had a normal type of income statement that we put into a budgeted type of format and then wanted to run a bunch of scenarios with it. Would be much more difficult given the nature of the expenses being mixed in many cases instead of broken out by behavior between the fixed and variable costs. Now, we can consider this in terms of a worksheet that will just be broken out in this format. We're going to say, okay, here's the same idea. We've got the sales, we got the variable costs, we got the contribution margin. Let's just put the units up top now, and we could just say, okay, here's the 208 sales times the 20,000 units, gives us the 4,160,000. Here's the variable cost, 148 times the 20,000 units, gives us the 2,960,000, and the contribution, 60 times the 20, 1,002,000, or 4,160,000 minus the 2,960,000 is the 1,200,000. Fixed costs remain the same, and this all calculates out. And we could put then, well, what would happen at 30,000 right next to it, which would be the 208 times the 30,000, 6,240,000, the 148 times the 30,000, 4,440,000, 60 times the 30,000, 1,008,000, or 6,240,000 minus the 4,440,000, 1,008,000, and so on. And then we can say, okay, what would happen at 40,000? What would happen at 50,000? And we can break these out very easily, and you can see how this type of setup can give us a nice picture of how things could look in a forecasting type of perspective very quickly with very minimal type of changes, as opposed to, of course, once again, a standard kind of income statement that we were going to budget forward, given the fact that we're breaking this one out by behavior, by the how the costs act in terms of fixed or variable in nature. In this presentation, we will discuss the concept of composite units and apply break-even analysis with it. The concept of composite units are going to be used when we have more than one type of inventory unit that we are selling. If we think about the standard break-even type of analysis, we usually apply that to one inventory type item. And you might be asking as we do that, what if we have multiple types of inventory that we sell? We don't have just one type of inventory item that we sell. We have multiple, and therefore the break-even analysis would be much more complicated. There is a way to apply the break-even analysis types of calculations with multiple types of inventory. One way to do that is to use the composite unit. In essence, we're going to break this information down as if it was one composite unit. Apply the break-even analysis in this format. To do that, we're going to need some information. We're going to have to make some assumptions. We'll have to have at least one added assumption that will be applied. In our example, we're going to say that we are making products A, B, and C. So these are the things we sell. Product A, B, and C. These are the items we sell. Now we're going to start with a ratio of the products. We sell them in a ratio of 4:3:3. We'll discuss what that means, but this is one of the assumptions we have to have. We've got to say, what's the ratio that we sell these products in? Because that ratio is going to be necessary for us to calculate what the composite units will be. And then we've got our fixed costs, and this, of course, is going to be needed anytime we have the break-even analysis. Just like if we only had one product, we would have the fixed costs in order to perform the break-even analysis. We then have the price and the variable cost broken out by product A, B, and C. The price then, what we sell them for, A, $44, B, $119, C, $269, and then the variable costs per unit for, again, what we sell A, B, and C, 27, 72, and 97, A, B, C, respectively. So now we're going to break out this information over here. I'm going to break out this ratio analysis, the 4:3:3. Anytime you see this, you might see this in partnership type problems, and of course in a problem such as this, where we're going to break this out into a ratio format. What you want to do is always just basically put this in A, B, and C, write this out 4, 3, and 3, and then perform the ratio analysis. The ratio analysis is just going to be the summing of these items up to 10, 4, 3, 3, add up to 10, and then take each item 4 over the total of 10, 4 or 0.4, which is 40%. And if we did that to the 3 divided by 10, we would get 0.3 or 30%. In other words, we get 40, 30, 30. That adds up to 100. That's why it's going to be the ratio. This is a format of us breaking this information out into a ratio. Why don't we just say 40, 30, 30? Well, it's easier to use the ratio analysis here because sometimes it won't be broken out exactly as a percentage. That's the general reason why we have this type of format, because we can use it more often. It's more exact if we're not talking exact percentages. Now we're going to calculate the price per composite unit. So what we're going to do is combine, like we're going to make some kind of freakish unit here where these may not be at all the same, these types of inventory items, but we're going to combine them together as if they're one inventory item. And we're going to come up with one price, and that's going to be the price per composite unit. So that's our goal now. We want to get the price per composite unit, then with the variable costs per composite unit, that will give us the contribution margin per composite unit, on which we can use the break-even type of analysis for it. So price per composite unit, we're going to have our items, our inventory items, A, B, and C. And then we have our ratios, 4, 3, and 3, as we saw in the prior presentation here. And then we're going to have our prices. So here's our prices, 44, 119, and 269. This is how much they cost individually. And this is, in essence, our ratio analysis. What we're going to do is just multiply this out. So we're going to take the 44 times the 4, the 3 times the 119. So 4 times 44 is going to give us the 176, and so on. So here's our, and we're basically applying out our ratio in this format. So the 4 times the 44, 176, the 3 times the 119, 357, 3 times the 269, 807. If we add up the 176, the 357, and the 807, we come out to 1,340. This is going to be our price per composite unit. So we've kind of combined them together, and we've gotten our price per composite unit. The next thing we're going to do is have the variable cost per composite unit. Variable cost per composite unit, similar type of calculation. We're going to have the units again, the inventory items A, B, and C, the ratio 4, 3, 3. And then we have the variable costs given in the problem by inventory item, the 27, the 73, the 72, and the 79 variable costs. Multiplying them out, we would then get, of course, something like 4 times 27. It's going to give us the 108, and so on. So we're going to multiply these out, and then adding up the 108, the 216, and the 291, we get a total variable cost per composite unit of the 615. 615. Now we have a variable cost per composite unit, and we have the price per composite unit that we have now calculated. We can then perform our break-even analysis with these numbers. We can take the price per composite unit, 1,340, subtract out the variable costs per composite unit of 615. That gives us a contribution margin of 725. So there's kind of our standard type of breakout. We now have our contribution margin. If we wanted to apply a contribution margin ratio, we could take this number and do the ratio 725 over 1340, and we can get our contribution margin ratio like so. We can next thing we're going to do is take this number and figure out what the break-even point is. So now we've got our numbers to figure out the break-even point. We have the one number, the contribution margin per composite unit for the break-even point. We can now take our fixed cost just as we would if we only sold one inventory item. Here is our fixed cost. It is what it is, something like the rent. And then we would take the contribution margin per composite unit that we have just figured out, the 725. The 725, if we then divide that out, we're taking the 19575 divided by the 725, and we get the 27. So the 27 is the break-even point in composite units. So this is how many composite units we would have to sell. And remember, the composite units is kind of like a conglomerate of the ABC units, as if they were basically one unit. We'd have to sell the 27 at the composite sales price that we figured out. But of course, in reality, we're not going to be selling 27 ABC units. We're going to be selling units A, B, and C, not for a composite sales price, but for the prices given here, 44, 119, and 269. So then we can think about the number of units of each product to be sold to get to that break-even point. In other words, how can we break this 27 composite units out into what actually will be sold in terms of units, in terms of A, B, and C sales units? So for that, we're going to take our ABC units. We're going to take the number of composite units, which is the 433, basically our ratio, the ratios that we use in order to construct the composite unit sales price. We're going to take the number of composite units to break even. that's going to be the 27. So we're taking this 27 and the 433, multiplying that out. So the 4 times the 27 is the 108, the 3 times the 27, 81, and of course 81. Then if we add this up, we're going to say the 108, the 81, and the 81 is the 270. So which is, 27 times 10 or 27 times 10, because that's of course what adds up the 4, 3, and the 3 that we use to break out that ratio analysis. So we have that same kind of comparability between these items. If we were to say take the 81 over the 270, we get that 30%. And if we took the 108, over the 270, we get that 40%. So we have the same kind of ratio analysis breaking this out between A, B, and C. This is the unit sales at the break even. So this is going to be the units that we will sell. Let's put this into an adjustment or a contribution margin worksheet, contribution margin income statement to test the break even. So we'll now put this into a contribution margin income statement, and we expect the bottom line to be 0 because we're testing the break even amount at this point. So what we're going to do is we're going to take the sales, we're going to break the sales out between A, B, and C. We're going to take the units that will be sold, which we figured out to be 108, 81, and 81. The sales price, which were given in the problem, this is what they are sold for, no composite units, the actual sales price, the 44, the 119, and the 269. Multiplying these out, the 108 times the 44 is the 4752, the 81 times the 119, 9639, and the 81 times 269, 21,789. If we add these up, the 4752, the 9639, the 21,789 gives us the 36,180. And then we're going to take the variable costs for the A, B, and C units that we will be selling. We have our same unit items here, which is the 108, the 81, and the 81. The variable costs given in the problem, these are the actual variable costs. These aren't the composite units, the ones that were originally given in the problem. 27, 72, 97. If we multiply that out, then, for example, 108 times 27, we get the 2916. So if we did that all the way down, we're going to get these items for A, B, and C respectively. Adding up the 2916 to 5832 and the 7857, we get the total variable cost 16,605. Then if we take the sales minus the variable costs, that's our contribution margin. Contribution margin 19,575. If our break-even analysis is correct, then that should match our fixed costs to have a 0 profit. So, and that's what we've basically shown here. So this is one format, this composite unit type of format that we can use to do a similar kind of break-even type analysis. To do that, remember, we have to be able to have that ratio of a breakout between the sales items for our units of inventory, in this case A, B, and C, and then we can use this composite unit system in order to do a similar type of break-even analysis as we would if we only had one inventory item. In this presentation, we will discuss operating leverage. This will be the data set we will be using. We'll have two different companies, two sets of data, company C, company D. The data we will be considering is the sales, the contribution margin, and the fixed costs for each. You'll note as we consider leverage, the operating leverage, we're looking at this big difference between the allocation of the costs between fixed and variable. In other words, company C's data set, we have a lot allocated to fixed costs as compared to company D, a lot more fixed costs in C than D. And the contribution margin for C is 60% versus the contribution margin for D, 20%. In other words, C is in the type of company or has a situation in which much more of the costs are allocated to the fixed portions, the things that don't change with the level of production, as compared to the variable. Whereas if we go down to D, we see that the fixed costs are relatively low and therefore the variable costs are relatively high. If we consider this type of situation, you might think of something like a movie theater or something up top where we have to basically pay the rent on the theater whether or not more people are in it or not, whether or not the sales go up or we have more people using the theater or not. The fixed costs might be the same in that type of scenario, as opposed to a situation where If we sell something like we sell food or something like that, we may have a much larger component in variable costs, and the costs then much more of the costs going up with each level of production, with each unit of production. So what would happen if we can consider these things with regard to operating leverage? What we're looking for is some tools, so that when we consider increases and decreases, we can consider the effect on the bottom line. It's one way for us to measure this kind of difference, this measurement difference between the fixed costs and variable costs. It's one way we can do so with different companies, looking at ratios to do this with different companies that may be of different sizes and have different overall revenue and expense numbers. So first, we're going to start off with our standard contribution margin income statement. This will help us to just consider the data. Remember, this is kind of our default statement with a CVP analysis. We got the contribution margin income statement. It's going to be ending up in net income like a normal income statement, but we're breaking off the costs by behavior between fixed and variable costs. So we're going to start off with the sales, which are given to us at the 1,000,003 and the 2,000,003. So that's going to be the 1,000,003 and the 2,000,003. The next thing we would typically see in our contribution margin income statement is variable costs, but we don't have variable costs, and that's going to be typical in a book type problem. They gave us the contribution margin percentage, so that's what we're going to have to consider, the contribution margin percent. Well, we know that the sales minus the variable costs equals the contribution margin, and the contribution margin over sales equals the contribution margin percent. And therefore, we can figure out what the contribution margin is first with these numbers by saying, well, sales is 3,100,000 times 0.6 or 60%. And therefore, the contribution margin is going to be 1,860,000. So we want to be able to do that with these types of calculations. We want to be able to see the relationship, both to see the relationship and two, so that if we're asked any test questions on it, we can basically understand that. So we got the contribution margin here. Also note that if you look at textbooks, they might show you different formulas as if it's a different formula to figure out these items. What you want to do is basically remember this format. Sales minus variable cost is the contribution margin. Contribution margin divided by sales is the contribution margin percentage. In other words, you don't want to rememorize another formula to figure out what the contribution margin is. You just want to basically plug in the missing information. As long as you can write the algebraic equation with one variable missing, you don't want to rememorize multiple equations that have different formats of the same equation. In other words, and I know this is ugly, but bear with me here. If we say the contribution margin percent, that's what we typically think of. We're going to calculate the contribution margin percent is going to be the contribution margin here divided by sales there. And that's going to give us the contribution margin percent. But in our question, of course, we already had the contribution margin percent, and we didn't have the contribution margin amount. Well, you know, a book problem might tell you, here's the formula to figure out the contribution margin in that case. Contribution margin equals sales times the contribution margin percent, as if you have to memorize a whole new formula. You don't really want to memorize a whole new formula. You just want to recognize that the missing variable here is going to be the contribution margin. And then we just use the same formula, and then you don't have to memorize another formula. You work the algebra to solve for this item as the missing factor. So just keep that in mind. If you start to look at managerial accounting and start to think that there's all these different formulas, sometimes they might just be variants on the one formula, and you just want to remember that you could basically remember the main variant of the formula, plug in the missing variable. Next, we're going to calculate the variable costs. So if we have the contribution margin, and this is the same case, contribution margin is usually calculated as sales minus the variable costs, giving the contribution margin. Well, if that's the case, then we know that the variable costs is sales minus the contribution margin. So if we don't know the variable costs, then we're just going to take the sales 3,100 minus the contribution margin 1,860,60000, and that gives us our variable costs. And then we could double check this. 3,100,000 minus 1,240,000 equals the contribution margin, and that divided by the sales, 3100000 equals the 0.6 or 60% contribution margin percent that we started with. So we do that for C and D. I'm not going to do all the calculations for D as well, but notice similar types of calculation up top. Then we're going to have the fixed costs. Those are given, so those are pretty easy. They don't change. They are what they are. They're given in the problem, and they're very different. We got the 1,390,000 versus the 150. If we subtract those two out, then we get the net income. So this is going to be our starting point. This is basically our net income calculation with a contribution margin type of income statement. Now we're going to take the top of that income statement, sales, variable cost, contribution margin, and calculate the new item we're considering here, the degree of operating leverage. This is the area we've been looking for. So we have the contribution margin. So here's the contribution margin we're pulling down. And then we're going to say the net income. And the net income is 470. We don't have that in our data set, but that's the 470 and the 490. So there we have that. And then if we divide those two out, we're going to get our degree of operating leverage. So we're taking the contribution margin, 1860000 divided by 470. And that's going to give us, it's not perfect here, 3.96 about. There is rounding. We're going to round to 2 decimals and just be aware of that. If our information doesn't come out perfectly, it's going to be a rounding information. If we had this in Excel, it would take into account the full number rather than us rounding to 2 decimals. So just keep the rounding in mind. It's something we always have to deal with. So now we can consider our situation. How would we use this to illustrate what kind of questions we would want to answer? Let's first think about a full contribution margin income statement as if there's a 20% increase in sales. Remember, when we think about the CVP, we're often projecting into the future. So we're saying, well, what would happen if there's a 20% increase in sales between these two type of industries, C and D, these two companies that are very different with the distribution of costs between variable and fixed type costs? Well, we can start off with the sales is going to be increased by 20%, which of course is going to be, we can calculate this 2 ways, 31000, there we go, times the 0.2, 20%, there's the increase, plus the original number, 3100000, there's our sales. Or of course, one way with one calculation, 3100000 times 1.2, 120%, 20% plus 100%, and there is our 3,720,000. So that's increased. We also know that the variable costs are going to increase. Why? Because they increase in the same percentage. That's why we broke them out between fixed and variable. So we're going to say that means that the 1240 times 1.2 is going to be up to 1,488,000. So we know that's the case. And then we know the contribution margin is going to be subtracting these two out. So we've got the 2,232,000, D's following suit. I'm not going to go through the calculations for both, but just note D's following suit here with the related numbers. Fixed costs remain the same. These were the same fixed costs we saw at the beginning with the given data, and that gives us the net income. So we've now calculated our change with this what if kind of analysis. What if there's a 20% increase? The next thing we're going to want to know is, well, what's going to be kind of the percentage increase, or what's the change from net income, what we had before, 20% after. We had a 20% increase in sales. What's the increase in net income from a dollar amount and the percentage increase? Well, here's how we got that. We're going to say, here's the contribution margin income statement before. Here it is after. We could say that the net income change for C and D, so if we calculate C again, it's going to be the 470,000 minus the after number, which is 842,000, and there gives us our $372,000 change. So there was an increase of 372 versus 128 when there was a 20% increase in sales. That's useful. You can see that big difference here. And that's useful here because the numbers are relatively similar as well. You can see that they make relatively similar amounts of revenue. But what if we're talking about industries and companies that don't make anywhere near the same type of overall revenue, but we want to see the relationship between the numbers? Then we want ratios. We want the percentage change. So now we're going to consider the percentage change and say the percentage change is usually the change, 372,000, divided by the original number where we started at. In this case, the 470. And that's going to give us the 0.79. So now we've got the 0.79. If I do the same calculation over here, 0.26 for D. So we can see there both ways we can see, and it's very distinct in either method. We can see the dollar amount being very different with a 20% increase, much bigger dollar amount change in C than D. And even if we didn't have the same dollar amounts, but the same relationship between the data, between variable costs, fixed costs, contribution margin, net income, we can still do a comparison and use this percentage change and say, wow, a 20% increase in sales results in a 79% increase for company C and only a 26% increase in D. Why? Because of that big difference in the distribution between variable costs, fixed costs. An increase in sales in a company that has mostly variable costs will increase the variable costs in a similar relationship. An increase in sales for a company that has a lot of fixed costs means those fixed costs will remain fixed while the sales go up. Therefore, if we're in a type of industry that has a lot of fixed costs and we can increase sales, we might see a very substantial increase in the bottom line as well, as opposed to a company that has a lot of variable costs. For example, if we had the movie theater, or if we had a restaurant, or if we had hotels or something like that, if we had hotels, let's say, and we increased the amount of occupancy in the hotels, well, if we had a lot of fixed costs, a lot of the costs are basically the rent of the hotel, and it is what it is, whether people are in it or not. And therefore, if we only had a couple people that are staying in the hotel and getting revenue versus an increase in that, if a lot of our costs are just in the fixed costs of the hotel, just maintaining the hotel, whether there be people in the room or not, a lot of fixed costs, then the increase in sales will have a substantial increase on the bottom line, as opposed to a type of business where the variable costs are very similar to the fixed costs. If we sell food, the actual food items that we sell, as opposed to the space, the actual food items that we sell are going to increase in the same proportion. The variable costs will increase. Much of the cost will be variable, will be increasing in a similar proportion as the sales. And therefore, an increase in the sales won't have as much an increase on the bottom line, because the variable costs will be increasing in a similar proportion. How can we get to this calculation a little bit more quickly? We can consider this calculation a bit more quickly with the degree of operating leverage calculation that we saw in the prior slide. So now we have our degree of operating leverage. If we take our degree of operating leverage and multiply it times the percent increase in sales, in other words, we calculated the degree of operating leverage taking the contribution margin divided by the net income, and then we can do projections and say, well, what would happen if there's a 20% increase in sales, and just multiply this item out. So we can say, all right, well, if there's a 3.96 degree of operating leverage times 0.2, then we've got about 79.2%. And again, there's rounding in these numbers, so be aware of that. But these are generally projections in and of themselves. Therefore, the roundings are estimates, and we just want to round to the point that is relevant for our information. So here we're going to round to 79 and 76%. So note we get to that percentage increase a lot more quickly here, and that's going to be one of the advantages we have to the degree of operating leverage type of calculation. We could say, okay, well, let's compare these two types of industries, and let's consider types of increases and types of, what if there's a percentage increase in sales? What would be the effect? What would be the effect on the bottom line, on the net income? Top line sales increases. What's the bottom line effect on the net income? Why would it change from company to company? Because of the behavior of costs, because of the difference between variable costs and fixed costs, the allocation between variable and fixed costs between different types of companies, different types of industries. In this presentation, we will take a look at some of the cost volume profit analysis, or CVP analysis assumptions. These are going to be some of the assumptions you've probably seen along the way, some of the limitations that we see along the way. In other words, we see these items and say, hey, this isn't exactly how things are work. We might have made some estimates oftentimes in some areas to simplify the process. Remember that when we consider the cost volume profit analysis, we're doing projections oftentimes And oftentimes we're going to be using estimates. We're not going to be exact in some areas. And there's arguments that in some cases that non-exactness could cause major problems. There's people that say that the CVP is not as beneficial as we might think in first glance, because at first glance it looks great because we want to be able to put things down into a numerical format. If we put things down into a numerical format as much as possible, then our analysis is something that we can break down in a very efficient type of way. But if we have to make assumptions that don't apply, then we need to be mindful of those assumptions, and we need to decide whether or not the application of the CVP analysis is going to be appropriate or not, and or when it would be appropriate. In what areas would it be most appropriate? When would the assumptions that are there possibly be large enough for us to have concerns with, or at least qualify some of our information? So just remember, the idea here is CVP is going to be a tool. We're going to go through some of the problems with it, which are going to be some of the assumptions that are made that could cause problems. And then we'll discuss some arguments for the CVP analysis, some arguments as to why the assumptions and making them may not be as big a deal. So some of the assumptions that we have, and we've pointed these out along the way, that we can classify costs between fixed and variable costs. So note what we've done is that this is the first primary assumption we do with the managerial accounting. With cost volume profit analysis, we say, hey, we're not going to be grouping things by what they do for us in terms of expenses. We're going to be grouping them by the behavior of the cost. Do they act as a variable cost? Do they act as a fixed cost? Because that's going to allow us to break out our income statement to a contribution margin income statement, which is going to be the variable costs minus, which is going to be the sales minus the variable costs, and then think about the fixed costs as a separate section. That's the whole basis that we're going to have to set up our process in. And we've noted earlier that we have some costs that are mixed. This is not a perfect world. We're not going to be able to go through the income statement and say there's a perfect linear relationship that as our production goes up, the costs will go up with some items, with the variable costs, and that other items are simply fixed, and that's just what it is. They never change. Note that's never exactly the case. That's never going to happen almost. And even the rent in terms of fixed costs will go up after a certain point in time, because we're going to possibly need more property as we increase the sales volume. So note that these are huge kind of assumptions that we're making, and we've talked about some methods that we can do to make these assumptions more clearly. But note, of course, that's going to be a big assumption that we have, and there's no simple way to do that. If you're thinking about your financial statements and saying, it's not as easy for me to break these out into variable costs and fixed costs. Well, it's not, because you're going to have to make assumptions to do that, and making those assumptions is one of the steps that need to be taken to apply this tool, and living with the problems that come with that, the possible errors that come with that, is part of the cost of applying the tool as well. Next assumption, that selling prices per unit, variable costs per unit, and fixed costs will be constant. So again, we're assuming that these things are going to be constant over time as well. So the selling price, note that we're basically, if we're projecting out into the future, we can't use this analysis if we're going to say, well, the sales price will be this much, and then it'll go up in a week, and then it'll go down, it'll fluctuate all over the place. It may fluctuate in real life. We might make decisions to increase or decrease the sales price in the middle of the year, in the middle of the month, constantly, and it could happen. But we can't really make the analysis with that assumption being the case. So one, the sales price, the variable costs in a similar fashion, we're going to assume are going to be constant. And again, we'll see some arguments why this is okay, but just remember that there are arguments for and against this, because of course, depending on where we are, the sales price could fluctuate quite a lot. Same with the variable costs. And again, the fixed costs, you would think, depending on the types of fixed costs we have, like the rent, you would think would be pretty fixed for a certain amount of time, unless we needed more property, but it could be variable at some given point as well. And then we have a constant sales mix. And we talked about if we had different inventory items, and we were trying to figure out the CVP type of analysis, that we're considering a constant type of sales mix, the ratio at which we sell our inventory, so that we can then apply out this systematic numerical method. And the sales mix changing could be a significant factor. It might not be a consistent sales mix. We might sell a lot more of one product or another product, and if we don't know what the sales mix is, then it's going to be difficult for us to assume, a consistent sales mix in order to figure out the cost volume profit type of analysis. So arguments for the cost volume analysis. Notice that what we looked at are these assumptions, and these assumptions are usually given as problems to the cost volume profit analysis. Note that in managerial accounting, oftentimes there's a big drive to get things to be numerical, because if we get things to be numerical, they feel more exact. We can use actual numbers as measurements. Whereas if we can't do things numerically, we're kind of in the clouds. We're kind of just guessing as to what things work or not. We can't really compare one thing to the other. The more we can put things down in a numerical fashion, the better off it looks to be. However, of course, if the assumptions that we use to put things on paper are not, applicable, then the having them in numerical form may not be as valuable as we would have thought. And those assumptions are some arguments to say, hey, this isn't as valuable as you would have thought because of these assumptions. Now, some arguments against those assumptions and for the cost volume profit analysis. And note, as we make these arguments, you think about this from a business by business perspective, because CVP, cost volume profit, is not like financial accounting. It's not required. Do we want to use this tool or don't we? The question is, does it provide us benefit to do so or not? Does the tool give us better decision making on it? So we have deviations from the assumptions are minor. This is going to be one of the arguments that we could have. We could say, hey, look, there's going to be deviations from the assumptions, the variable cost, the fixed costs, breaking them out between variable and fixed. But we could say, hey, the deviations we believe are going to be minor, and possibly the deviations could go either way. They could deviate one way, and if we take all the minor deviations in our assumptions and net them together, in other words, it's quite possible they could net out and have a minor effect, be in essence correct. Now, again, they could net out and they all could go the same way for some random reason. It's just basically, it could randomly be that way, So but it also could be the fact that these small assumptions would be minor, and the small assumptions then could be in such a fashion that they cancel themselves out and therefore result in minor variations, and therefore the cost volume profit analysis would be good because it's just an estimate. And that's going to be one of the key factors that we want to keep in mind here, and that's going to be the last one. CVP is an estimate. So the fact that it's not going to be perfect, the fact that we're making estimates, the fact that we're making an estimate between variable costs and fixed costs, and we're doing things, certain type of analysis to break out between variable costs and fixed costs, well, that's part of estimating. If we're trying to project into the future, we don't have any better way of doing it. We've got to use something to project into the future. Using a numerical fashion, making some type of estimates to do so is, as good as we can do to make those assumptions, and, breaking things out by behavior from that argument would be a reasonable way to go. The sales variable costs and fixed costs are often close to a straight line on a graph when assumptions are within a relevant range. And this is this item that, remember, there was an assumption saying that we're assuming that the variable costs, fixed costs, and the sales are going to be constant. And they could change, note, and that's true, and it depends on industry, but usually they're going to be fairly constant within a relevant range. So, in other words, if we're talking about the production of inventory within a relevant range of units, producing from this amount to this amount within a relevant range, then you would think the sales would be relatively constant within that relevant range. If we go past that range, you would see deviation and change. The costs are probably more volatile. We have more control over the sales, so we can kind of predict what the sales will be. We might make some little deviations depending on the industry we're in, increasing and decreasing sales, but you would think they would be fairly constant, what our sales price is within a relevant range. And then the variable costs could change too, because we've noted that variable costs could have some variation to them. But the standard type of variations that we look at with most variable costs are usually can be approximated with a straight line fairly well within, again, a relevant range. fixed costs in a similar fashion are usually, if they're a standard type of fixed cost like the rent, are pretty solid within a relevant range. But nothing is completely solid forever. It's not going to be the same forever. The rent's not the same. If we need to make a lot more units, we're going to need more space, and therefore we have to buy more place to rent more. So the rent could go up at that point in time. But the assumption here being that it should be fairly constant within the relevant range. So note, in conclusion then, when you talk about cost volume profit analysis, people that really like it really favor it because they're numerically oriented generally, and they want to come up with a numerical systematic approach to something. Also note, however, that there are problems with it, and just because we have a numerical assumption doesn't mean that we shouldn't take into consideration those problems with it. If we just because we have a number that says something doesn't mean that we have to know what that number means. We have to say, okay, what are the limitations to the calculation that we have here, and are they relevant to the number that we've come up with? Could they be a factor that could significantly flaw the numbers that we've come up with?